Good morning. It is 9 a.m. here in New York City. This is Yahoo Finance Live. I'm Julie Hyman with Brad Smith, and here are three things you need to know this morning. Tomorrow's inflation data and Wednesday's Fed decision will grab investor focus this week. A strong CPI number for May would reinforce the idea that the Fed has a lot more work to do in cooling a still resilient economy. As ever, the core figure is key. Headline inflation has gradually edged down, but the reading excluding food and gas has been sticky, and it's likely to stay well above the Fed's comfort zone. Investor bets are for the central bank to pause hikes for the first time in 18 months, but you could call it a hawkish pause. The bond market's higher yields tell us the battle over price rises and higher rates might not be done yet. Investors seem convinced the Fed will pause, but there's less certainty on the outlook for stocks. Wall Street has weighed in, with Goldman Sachs lifting its year-end target for the S&P 500 to 4,500. And the strategists there say the index could keep climbing as other sectors start to catch up with tech's stellar performance. Morgan Stanley, though, taking a different view, as it has been, and respectfully disagreeing that the bear market's even over due to earnings forecasts for the year ahead. Analysts there pointed to the bear market of the 1940s, which rallied 24% before hitting a new low. And Donald Trump is making his way to Florida ahead of an appearance before a federal judge on Tuesday. The former president faces a 37-count indictment for mishandling classified documents after leaving the White House. He was busy over the weekend speaking at several rallies, and he told supporters in Columbus, Georgia, quote, "I will never be detained." He went on to slam federal officials, calling them corrupt and crooked. Trump said the only good thing from the indictment were his poll numbers. They do not seem to be hurt by the developments. A fresh CBS News and YouGov poll has Trump topping main GOP rival DeSantis by 38 points.
Well, Donald Trump is making his way to Florida. Ahead of an appearance before a federal judge on Tuesday, the former president faces a 37-count indictment for mishandling classified documents after leaving the White House. He was busy over the weekend speaking at several rallies. And Trump, here was what he had to say.
The joke of an indictment, it's a horrible thing. It's a horrible thing for this country. I mean, the only good thing about it is it's driven my poll numbers way up. Can you believe that? Way up.
So it's not incorrect. The fresh CBS News and YouGov poll shows him topping Maine GOP rival Ron DeSantis by 38 points and holding his grasp among GOP voters in general. A separate poll asks if his indictment was politically motivated. Most surveyed said it was. A poll from ABC News and Ipsos has 48% of respondents saying the DOJ was correct to charge him, while 35% disagreed. Joining us to discuss what could happen next, criminal defense lawyer Brian Weiss. Great to have you here today. First and foremost, of the charges that you've been able to look through and what we've seen so far, what does the defense look like?
You know what? My clients have an expression when they find themselves gemmed up, much like the former president. They say, wow, cancel Christmas. I don't know if the former president has to cancel Christmas, but Brad, make no mistake, he is in a world of hurt. As anybody who's ever watched Billions understands, Paul Giamatti, the Chuck Rhodes character, loving to berate potential defendants by telling them, you shouldn't have made a federal case out of this. Why? Because as your viewers understand, the federal system is as radically different from most state systems is night from day. First of all, defendants plead guilty 98% of the time. Those foolhardy enough to go to trial are convicted 98% of the time. They do 90+% of their time. And viewed against that backdrop, like you said, Brad, 37 counts, 49 pages, more pictures than I've ever seen in any indictment in 45 years. But what makes this indictment what we call a speaking indictment, an indictment that tells a narrative with the beginning, middle, and an end, is that, Brad, this indictment is chock full of this defendant's own words, own admissions, and more than that, what we call consciousness of guilt, his intent to hide, conceal, lie, and destroy evidence.
Let me ask you, though, Brian, as cut and dry as it may seem, it's going to take a while, right? Talk us through the process here. It's not as though he gets arraigned tomorrow and then he goes to prison a week later, right? This is potentially, what, a months-long, if not years-long process.
Julie, you're absolutely right. Look, even though every defendant in the federal system has the right to a speedy trial, this is a marathon. This isn't going to be a sprint. And I think one of the reasons why we need to be in for the long haul is District Judge Eileen Cannon, who we all know from very early on in this process, she was allegedly picked at random to hear this case. She could do everything in her power to put a stick in the government's spokes, so to speak. How? By delaying this trial, by suppressing critical evidence, and by even going so far as to grant what we call a directed verdict at the end of the government's case in chief, meaning she's found as a matter of law, the proof is insufficient. Now, I think what's going to be important is the fact that Judge Cannon, who apparently seemed to be auditioning for the 11th Circuit Court of Appeals last year, was, as they say in West Texas, called out like a punk by the 11th Circuit for just being wrong from here to there. But we know, guys, that like a home plate umpire in Game 7 of the series, she can squeeze the strike zone on the government. And that's something I really think we're going to have to keep a watch on as this case unfolds with the first step tomorrow in federal court, guys.
What does it say to you that Trump's defense team, and this was the kind of shocker on Friday, that they stepped away from this case? What do you believe had to be seen within the case itself to be so detrimental for them to say, you know what, we're out?
Well, you know, Brad, that's a great question, because I think what we've seen over the years with this defendant is that being a lawyer can be hazardous to your health, hazardous to your profession, and hazardous to your law license. Look, you had Jim Trusty, you had John Rowley step aside, you had Tim Parlator step aside before them, and now he's become a talking head on TV who's on more than Andy Griffith reruns. Look, this is a situation where not every well-paid, high-class lawyer wants to involve himself or herself. Look, my understanding is that the president will now add Todd Blanche, a former AUSA in the Southern District of New York, again, from Billions, who has assisted on the New York case. But I also think what our viewers need to recognize is, speaking of that New York case, the difference in gravity, in severity between that New York case that Alvin Bragg brought and the ones that Jack Smith has brought in the Southern District of Florida. Again, it's like going from JV football on a Thursday night to the Super Bowl like that, guys.
Well, is he going to have to settle for some JV attorneys, though, if, you know, right? Because, as you say, if this is as serious a case as you say, and the risks for his defense attorneys are, as you say, then who's he going to get to defend him?
You know, if we as criminal defense attorneys, particularly what I do as an appellate lawyer, the lawyer of last resort, Julie, if we only took cases we thought we could win, if we only took cases where we thought we were going to get really good results and be on Yahoo and on page 1 of the Wall Street Journal above the fold, we'd be working at Dave & Buster's, because we wouldn't be taking any cases. There's always going to be someone somewhere who, like a moth to a flame, is attracted to the prospect of representing the former president in federal court. But make no mistake, what begins on Tuesday, the first step in a journey of 1,000 miles for this former president, is going to be something that could result, again, in substantial prison time. When you break down the 37 counts of this indictment, 31 counts of violating the Espionage Act, 5 counts of concealing or possessing government documents, and then 2 counts of lying with his body man, Wally Nalto, to the FBI, you're looking at 5 years apiece on each of the espionage counts, 20 years a pop on concealing or possessing, and 5 years a pop for lying. Again, we've said it before. There's a reason why no one ever wants to be defendant in a federal criminal case, guys.
Well, we'll see what ends up being the outcome of this one. Brian Weiss, thank you very much. Criminal defense lawyer, giving us some perspective here on the Trump case. The Fed's decision is the big event of the week. Investor bets are for the central bank to pause hikes for the first time in 18 months. What does the street expect ahead of the event? Sometimes you do get a little bit of dichotomy between the CME FedWatch tool and the rhetoric. Let's get to Yahoo Finance's Jennifer Schonberger for the latest. Good morning, Jennifer.
Good morning, Julie. Investors expect the Fed will take a breather at its policy meeting this week. But as you mentioned, there are divisions on Wall Street about whether the Fed will be done hiking rates or whether this meeting could constitute a skip versus a pause. Take a look at the Fed funds futures this morning. They're pricing in nearly about a 75% chance that the Fed will maintain rates at the current level of 5 to 5.25%. Most banks on Wall Street are predicting a pause, including Morgan Stanley, Wilmington Trust, Bank of America, and Goldman Sachs. Wilmington Trust's chief economist Luke Tilley says the consumer price index due out on Tuesday is just about the only thing that could knock the Fed off of a pause for this meeting. And while most major banks are predicting a pause, there are some outliers who still think that the Fed will hike by 25 basis points. Notably, Citigroup economists are expecting a 25 basis point rate hike, though they note it is going to be a close call. Now, what the Fed does afterwards is still up for debate. Morgan Stanley's chief economist Ellen Zentner says she thinks the Fed will pause at this meeting for good and hold rates at this level until the first quarter of next year, where the Fed, she thinks, will begin cutting rates. On the flip side, Bank of America and Goldman Sachs, rather, think that the Fed has just about one more rate hike to go, likely in July. We will get the Fed's latest expectations for interest rate projections at their meeting on Wednesday, hopefully offering some more clarity on just about how high rates could ultimately climb. Back to you.
All right, Jennifer, thanks so much for breaking that down this morning. Appreciate it. Well, a Fed pause seems fully baked in at this point, but are we getting ahead of ourselves ahead of tomorrow's CPI data? Joining us now, we've got Kevin Gordon, who's Charles Schwab Senior Investment Strategist. Great to have you here with us in studio this morning, Kevin.
Morning.
Absolutely. All right, so as we think about some of the data that's set to come forth this weekend, what do you believe the Fed would need to see within CPI in order to give them hard conviction for a decision one way or the other?
I think it'd have to be a pretty major upside surprise. Upside not in a good way, in a bad way, especially on the core side. But they probably left us with enough in terms of Fed speak, and then the labor report for May itself. That was probably enough to set us up for, if you want to call it a skip. I guess that's the new word now for June. But I think more important would be language around what it means for July. If it was a hotter number yesterday, and then even along with that, I think some of the wage data, that to me is going to be more interesting moving forward, because you have more research from some of the regional banks like the San Francisco Fed kind of talking about how the wage dynamics may not be as much of a driver of inflation that the Fed originally thought. So kind of putting less emphasis on the Phillips curve itself. I think it'll be important to see if Powell kind of reinforces that message and what it means for the broader Fed itself, the broader FOMC. That to me is going to be more important in conjunction with the update to the summary of economic projections. That's going to be, I think, pretty telling, especially if they adjust the unemployment rate statistic and what they expect for the end of the year. I think that'll be a pretty big tell, because if it moves up a little bit, to me, that would imply they have to be a lot more aggressive in the second half of the year.
In other words, the dot plot, the summary of economic projections, what we call in layman's terms the dot plot. And I'm also curious what you guys are looking at to try to, we always try to figure out what are some more creative or even accurate inflation indicators, right? Besides just CPI, besides just the stuff that we tend to look at. Is there anything that you guys are watching?
There's higher frequency metrics. You can look at, dining statistics if you want to try to get a gauge of what activity and services is like. But, the reality is, and our view has been for a while, that we can look at all the data that we want, and we can kind of get a gauge of, truflation, if you want to call it that. But the Fed has been pretty specific on what they're watching. So it's not even anything particular within CPI, it's within PCE. And then as we all know now, the core services ex-housing component. I think the distinction is really important, because even within core services ex-housing in PCE versus the same metric in CPI, they're calculated differently, and there's a higher and stickier weight in the PCE version. So we could look at the core CPI version, and if it's coming down and rolling over, that would kind of give us the indication, okay, it's okay to pause, but they're going to be focused on the PCE.
That's we can just ignore CPI then.
I wouldn't say ignore, but yeah, exactly. But I think it's important when you think about how they look at this. The fact that whether you like it or not, they are kind of tied more to lagging economic data, but that's really the position that they put themselves in right now.
The fun thing over the weekend sometimes is having conversations with friends and really discussing everywhere the consumer is and isn't. And we've seen weakness in some of those more discretionary categories continue to hold up. However, if you start to think about all of the other places where consumers are monitoring where the Fed's actions are going to impact purchasing decisions on a large scale. That's what's become, I think, more asked about at the brunch table, if you will, these days.
And it's tough, too, because, everybody's inflation is personal, and it sort of breaks down to geography at some point, because even here in New York City, I mean, if you tried to tell somebody, oh, inflation X housing looks great, I don't think you'd be, that wouldn't kind of yield a good response. Very different in another area of the country where housing isn't as, big of an expense. So I think you have to keep that in mind, but you also have to keep in mind this kind of stress in the banking system that has seemingly abated, at least, over the past couple of months. What I thought was pretty interesting in the most recent Fed minutes is that they started to cite almost the reverse of what you would expect from the banking stress, that it actually wouldn't lead to as much contraction in the economy, but that it would actually almost have the reverse of a supply side effect. That was just a little tidbit. It wasn't anything that they expanded on a lot, but I think that's going to be the other component that's crucial in the press conference in particular to see how much they expect that to feed through. Because if you don't get as much of a credit contraction from what happened in the banking system stress, if that's not as much of a damper on inflation, then you kind of have a little bit of a higher support and kind of a higher seal or a higher floor for inflation itself. That makes it harder for the Fed to ultimately get to the 2% goal.
One of the interesting things that's happened in the market this year is there was a big pricing in of a cut by year's end. That seems to have abated to some degree. And I wonder what it says about Fed credibility. Because at the time you think, well, one of them's going to have to be wrong, right?
Yeah.
And the market has now decided, well, we were wrong, maybe, right? So does that then imply that the Fed has sort of gotten the market backed in a sense?
In a way, I think if you look at valuations, certainly as you move up the cap spectrum, and that mega cap story has been widely advertised at this point, with that sort of being the only source of leadership, albeit it's started to change a little bit in the past week, which I think is a good sign.
Don't worry, we're going to talk about that.
Yes, but I think now you kind of have the problem of, so number one, I would say yes, it's good that the market has kind of priced out the majority of those cuts. There's still about one priced in for the end of the year, but the majority of those cuts being priced out as the market has rallied, but at the same time, that rally has been, there's been a strong bifurcation. So I actually think that, the weakness or maybe just kind of the muddle through economic scenario that the market is looking at is reflective of, when you look at the average stock. So, whether it's small caps or cyclicals, that, the lack of movement that you've seen this year, I think that's reflective of the broader economy and kind of the flight to quality and the flight to safety up the cap spectrum. I think that was, definitely accelerated when you had the banking stress with SVB and Signature and then First Republic. So I think that there's not much of a muddy kind of picture there as it might be portrayed.
Yeah. Okay, well, as I said, we're going to talk about some of these other issues. So hang on, Kevin's going to stay with us. S&P 500's bull market is here, at least if you talk to most people. It doesn't quite feel like it, though. In today's morning brief, Yahoo Finance executive editor Brian Sozzi outlines the trends he's seeing that are remarkably unbullish. He gives a few examples here. Target stock being downgraded on slowing shopper habits, Campbell's cheaper soups gaining traction, and CEOs planning for major layoffs, and cautious holiday shoppers. With conflicting signals, what does that say about where the market goes now? Investors are split on that matter. Morgan Stanley respectfully disagrees that the bear market's even over due to earnings forecasts for the year ahead. Analysts pointed to the bear market of the 1940s, which rallied 24% before hitting a new low. On the other side, Goldman Sachs is optimistic, lifting its year-end target for the index to 4,500 and arguing the S&P 500 could keep climbing as other sectors start to catch up with tech's stellar performance. Let's bring back Kevin Gordon, Charles Schwab, senior investment strategist. And this is exactly what you were just discussing. If you look at that Goldman note this morning, it's really interesting. And they have some various charts that show to such a degree that those few number of stocks have been accounting for the rally here. I think that they looked at mega cap is up something like 47% year to date, while the S&P is up much less. We've seen a little bit of signs of broadening, though.
Yeah, a tiny bit. I mean, it started a couple weeks ago, not this past Friday, but the one before, where you kind of saw this really strong participation on the part of small caps that carried a little bit into the middle of last week. And even, last week as a whole, you had started to see an outperformance of small caps and cyclicals relative to kind of mega cap tech or anything sort of tech adjacent. So I think, it's a good sign. It kind of always starts out a little bit as short covering, kind of, just buying up the names that were heavily beaten down. So to the extent that gets carried through, I think that's kind of the next hurdle that you have to clear. And our kind of view about this is that you're close to 8 months off the low from October. So if that was the low, we'll never know until we know. But if that was the low, I think what's going to be really important to kind of think about, especially at this stage, is we're not really checking off a lot of the boxes that you would typically see in terms of the strength of a bull market. So number of highs on a 52-week basis, new highs, the percentage of stocks trading above their 50-day or their 200-day moving average, that is all yet to be cleared. So I think if it was the start of a new bull in October, I think it would go down as one of the weakest in history.
And so for a lot of the melt up that we've seen, it's been FOMO driven as well to a certain extent here. Yep. So even if we were to see, not collapse back to October lows, but even if we were to see some type of retraction, would that mean that on the other side, FOMO can't drive it once again? Would that be kind of a sans FOMO type of rally that we would need to see in reattachment to some of the more firm fundamentals?
Yeah, I mean, I think for us, the most benign scenario and sort of the best case is that you kind of have a stabilization in those larger cap areas and then just catch up from the rest of the market. You don't have to see this, huge collapse, like you said, at the top of the market. That would obviously drive, a lot weaker performance at the headline and the index level. But even if that happened, I would look for kind of the reverse of what we've seen year to date. So if that was happening where, the Super 7 or the Mega Cap 8, whichever moniker you want to use, if those were collapsing but the rest of the market was participating and doing well, we would take that as a pretty bullish signal. Obviously, it's going to put more weight on everything, but that's exactly kind of what you had at the October low. The problem for us is it just didn't carry through. It only lasted for about a month or two.
And what about these sort of anecdotal bummer signals that Saz referred to in his piece? The sort of consumers may be trading down in some cases, the rhetoric that we're hearing from a lot of CEOs where they're really trying to put a dampen down expectations.
Well, I think that's part of the hard part about what became, defense in this, I don't want to say new era, but at least in the pandemic and then kind of the few years after, is definitely during the pandemic in 2020. Those defensives were the big tech names. And so it was really just the big five that were kind of driving returns. That has kind of, returned this year, where, they're not companies that have no earnings and they're low quality. Right. I mean, they are relatively high qualities in almost every metric. So it makes sense why people have flocked to those names. But at some point, it becomes a chase. It becomes the fear of missing out trade, but I think also the fear of getting out trade, where you're kind of hesitant to leave those areas and go to the rest of the market. So when you start to see that, I think it's going to be a better signal. But to your point about trading down, I think that's probably more of a theme this year because you don't have as much of the savings buffer, you don't have as much of the income growth that you had as the labor market continues to soften. You still have it in aggregate terms because we're still hiring a lot of people, but it's not as strong as it was maybe 12 months ago.
Yeah. All right.
Okay, Kevin, stick around. Thank you. Well, coming up, Carnival is cruising this morning after getting an upgrade from JP Morgan. We're going to take a look at some top movers next. Well, corporate profits have seen a big boost from higher prices this earnings season, with the world's biggest companies saying they have no plans to change course. They'll continue to increase prices for the foreseeable future, despite the fact that we've actually seen prices of oil, transportation, and food ingredients fall in recent months. Take Pepsi, for example. The company reported it had raised the average prices across its snacks and beverages by 16% in the first 3 months of this year. We spoke to CFO Hugh Johnson about those increases.
What you see going on as much as anything is, one, obviously, we've taken some pricing to cover the inflation. Consumers still want to have these small, simple, affordable treats and luxuries in their lives. So you may not be able to go out and get a new car. You may not be able to go out and get a really fancy piece of technology. But you can afford a bag of Doritos, or you can afford a Gatorade Zero after you work out, or you can afford an energy drink in the morning. So we tend to do pretty well through times when the consumer is more stressed on a macro basis.
And that strategy is cushioning corporate profits, but it's keeping inflation elevated. So how should this all affect your positioning? Let's get back to Kevin Gordon, Charles Schwab Senior Investment Strategist. So Kevin, when we hear about the pricing power, and you talked a moment ago about sort of classic defensive names, right? Do we stick with them? Do we take a look at them if you haven't already?
Yeah, I think, and we've talked about this before, the classic defense, if you're thinking about something like staples, particularly consumer staples, it gets a bit tough because they were, they benefited a lot from the inflation wave we saw in 2022. And this isn't just specific to staples, but the overall kind of corporate sector, ex financials. When you look at revenue growth in 2022, almost all of it was inflation. So there really wasn't any volume growth, no real sales, increase. So I think this year, as the war on inflation gets arguably, hotter and more aggressive by the Fed, they want inflation to keep coming down. You lose that pricing power if that was your primary source of revenue growth. If it wasn't and you have actual organic growth, then that's a good place to be. So that, in our perspective, is probably where you want to be positioned, not just in staples if you're kind of having that bias, but across all sectors. So I wouldn't look at, defense in this particular environment as classic staples, utilities, healthcare. I would extend it sort of, across, from a factor perspective, across every single sector, because that's worked really well, particularly in something like tech, which, is cyclical, and some components are cyclical, but some of those kind of stronger growth value hybrid areas like positive earnings revisions have also been really strong. That's kind of what's kept you in consistent, territory in terms of return strength.
For some of the companies that have had to take price action in the face of some of the weakening volume as well, is there still excuseflation present? Otherwise, looking across, their supply chains and saying, well, we're seeing higher input costs there, so we've got to pass that on to the consumer. Or wages are higher, we've got to pass that on to the consumer.
Not as much on, I think, the materials side. I think a lot of that has eased, especially with the softening you've seen in commodity prices. But what I think will be the bigger story this year for the broader economy, especially for the Fed, will be kind of these stickier labor costs. So you look at unit labor cost growth, it is still way above trend, pre-COVID trend, and the fact that you're not really seeing an easing in productivity growth or lack thereof because it's still deeply negative. So that convergence, I think, will be really important because, companies can only stomach those higher labor costs for so long, especially if you're not getting that revenue back and that revenue surge. It's working out in the near term a little bit because you're actually seeing forward estimates, earnings estimates hook back up for the broader market. But that convergence, I think, will be really important to keep an eye on, especially as it pertains to overall inflation.
You guys at Schwab have talked a lot about quality and that being the place that you want to be. For investors who sort of maybe have trouble getting their hands around quality, is there an index that they should be looking to? Like, what are some tools that you would offer?
There are some that track it, but I think, if you just think about quality kind of in the earnings realm, so actual strong profit margins, and admittedly, you kind of have to go more on a company by company basis, just because that's the nature of markets like this, whether you're in a bear, whether you're in kind of a choppier start to a new bull, if that's what it is. But it goes company by company, especially when you have what we were just talking about, the inflation dynamic that has persisted. But our kind of emphasis has been, especially quality as it relates to, it always kind of comes back to this growth and value debate. Don't really invest as much based on index labels, invest more on the factors. Because a classic example, I would say, the rebalancing that S&P just did in December, in their pure growth portfolio, now there's only one of the mega cap 8 that remains, and it's Apple. So when you look at that compared to Russell 1000 growth, which is a much broader net, Russell 1000 growth is outpacing S&P 500 pure growth by a significant degree, double-digit percentage points this year. So when you exclude those names that have been carrying everything, changes the trajectory a lot. So if you were investing based on factors, you wouldn't have to worry about this huge differential that's opened up in a couple of indexes.
And just quickly, for people who are not familiar with factors, I mean, they're effectively characteristics.
Absolutely,
it's another word for characteristics,
Absolutely.
right? And so some of the
strong free cash flow, a strong, actual realized earnings growth right now, strong profit margins, both in the rear view, but also estimated looking forward. So everything around what a company expects, not only in the future, because you don't want just a promise, you want sort of a guarantee that it's happening right now. So the mix of both of that is a strong profit margin, but maybe something like positive earnings revisions. That kind of gets you actually in a hybrid growth and value play, because you have the expectation of growth in the future, but you also have forward estimates moving up that brings down valuations. So it kind of gets you more in a sweet spot that way.
Cool. Kevin, thanks for being here.
Thanks,
Really
guys.
appreciate it. Good to see you. Kevin Gordon, Charles Schwab, Senior Investment Strategist. Well, we just had the opening bell on Wall Street, so let's do a quick check of the markets to see where we're opening up here this morning. And we're opening higher. All three major averages in the green here, so extending some of the gains that we saw last week, as technically the S&P 500 entered a bull market. Although, as we've discussed, there's some debate over the definitions here, right? But the S&P is up about 0.25% today. So is the Dow. The Nasdaq continues its leadership. It's up 0.4% today. So, Brad, it looks like maybe a little of optimism being. Oh, look, we're not optimism when it comes to the interactive, but we're getting a little optimism for what's going on in the markets today. I'm going to take it right on back over here. How about that?
Hey.
I'm going to take it right back on over here. And why don't we talk about some movers? Let's start with XPeng. Those shares are rallying this morning after the company disclosed on social media that over 25,000 customers have pre-ordered its G6 model, and shares of NIO are also getting a boost. The company slashing prices on all of its models in China just days after reporting a worse than expected quarterly loss. Those XPeng shares in U.S. trading are higher by about 9.2% here. Interesting that they made this disclosure via social media here, but that's one that we're watching. And then NIO said that it was cutting prices on all of its models in China by $4,200. So we've got not just XPeng, but the other big China automaker in focus today.
Yeah, much of the pricing war continuing to move forward here. Of course, you think naturally about in the EV landscape what Tesla has had to do in all of the regions that it operates. And we focus a lot on some of the U.S. price action. But in China, that's been interesting to track how companies are going to need to try and make sure that even in this kind of growth phase or part of the cycle for electric vehicle adoption, even as more of the infrastructure is coming online, the market is so competitive in China, and Tesla, NIO, XPeng, and all of the like, they're going to be kind of pulling all the pricing levers possible, especially considering that on pricing, it's probably a different, as we've talked about in the past, strategy that they move forward with, given that many of them are not traditional dealerships that you're operating. It's just how do you move this forward through your website and pushing through some of the marketing mechanisms there. So I don't know. Pricing right now is going to be ever changing, it seems. Yeah,
apparently the Chinese government has also started a campaign to boost the auto industry, to boost purchases, and also to boost, in particular, electric vehicle or hybrid vehicle purchases as well. So we'll see what that does for the numbers for these companies. Right. It was interesting to see Li Auto not participate in that rally that we were just watching there. Not sure what's going on there. If they also came out with numbers, I'll have to check through it and see if we can see anything. And
since you mentioned the government side, I mean, the add-on there is that there is an increased mandate year over year as well to up the number of electric vehicles that are being produced. Now, that would more so impact some of the legacy automakers, internal combustion engines and so forth, that are now making that switch over. But for companies like a NIO and an XPeng that have their roots or history, at least brief as it may be compared to some of the others, in electric vehicle standards and battery standard, that'll be interesting to see how they at the same time are able to try to compete within that market for more sales here. We're also taking a look this morning at Wall Street getting bullish on the cruise industry, from cars to cruises. JP Morgan upgrading Carnival this morning to overweight from neutral. Analyst Matthew Boss, friend of the show, cited continued demand momentum for the cruise industry in the upgrade. Shares are rallying on the news. We had a chance to speak to Carnival's CEO, Josh Weinstein, who touted the demand for cruises right now. Take a listen.
We had record numbers, right? We just got through the wave period, which is the highest booking period in the industry. We literally had the most bookings in the history of our company in that 3-month period. And that was both our North American brands and our European brands, which took a little longer to get back into that flow. So frankly speaking, between that and our first quarter results, where we beat on every single line item, things are trajectorying in the right trajectory.
The teleprompter says right now, Julie, still I'm not going on a cruise. And it's correct.
You didn't need the teleprompter to tell you that.
The almighty teleprompter is correct, yes. I'm still not going on a cruise.
I'm not going on a cruise either, but there are clearly enough people who are. There are a lot of people who are big cruise fans. It's interesting that we played that little piece of sound, I believe it was from Milken, perhaps from Josh Weinstein, because the analyst over at JP Morgan, Matt Boss, did cite meetings that Weinstein's having with investors, the optimism that he has been expressing as one of the reasons behind this upgrade. So that's interesting. And basically, he's talking about some of the expansions that the cruise line is making as well that will drive value for shareholders. So because there is still decent demand for cruises.
Within that demand, he also goes on and says multi-year Carnival Cruise Line has 6 private destinations around the Caribbean, about 5.5 million guests per year, rest of the industry in aggregate, and leveraging land-based assets as well to drive further value creation into the second half of 2025 and meaningful expansion of Half Moon Cay. So I don't know, for anybody who's going to that destination, they've got much more to look forward to.
Sounds like it. All right, and then we got another mover that we're watching here, and that is Biogen. Shares are rising this morning after an advisory committee recommended the Food and Drug Administration approve the Alzheimer's drug from Biogen and its Japanese partner Eisai after an earlier drug to treat Alzheimer's did not show much success. So that's why we are seeing this kind of a reaction in the shares. It actually was up more in pre-market trading, so it's cut that gain a little bit. But it looks like that the analyst commentary around this has been pretty positive as well, that this is good news in terms of reimbursement, potential reimbursement from insurers and from the government health plans for this drug.
Yeah, absolutely. And I mean, this is kind of a typical move that you would see in some of the biotech stocks, especially if there was a type of approval that the FDA or a green lighting that the FDA was set to signal here. They had already filed for marketing authorization as well for this treatment for early Alzheimer's in certain regions. South Korea, they already filed for that. And so they had some confidence that this would also be able to move forward here in the U.S.
Yes, although I think that given the situation with the last Alzheimer's drug, there was probably a little trepidation among investors until the thing is actually over the finish line.
Yeah, spot on. Also, everyone, coming up, the tech rally rages on, but are the sector's strong gains heading for bubble territory? We're diving into more next. So the S&P 500 is in a technical bull market. So good time to get technical with Yahoo Finance's Jared Blickery from the New York Stock Exchange. Hey, Jared.
Well, technically speaking, yes, we are in a bull market. I want to examine some of the biggest winners this year, and we know a lot of those winners are in the AI category. We're talking about names we know like like Nvidia, like Alphabet, like Microsoft as well. But I was looking at the S&P 500, some of the biggest winners this year. Tesla's in there, not a surprise. That's up almost 100%. AMD, not a surprise because that is a chip company, up about 90%. Royal Caribbean fills out the number 5 spot. That's up 85%. Then you have GE. That's been off my list for several years. That's up about 60% this year. Carnival up over 60%. Salesforce over 60%. Well, and then finally, Pulte Group, and I don't know if I'm saying that correctly, but Pulte, residential construction name. It's getting a little bit more broad-based, and so we're thinking back to that expansion of the rally last Friday, not last Friday, but the week before on that non-farm payroll, and is that going to stick? Another comment that really resonated with me from a guest prior was that this would be, if we are in a new bull market right now, this would be the most unloved bull market, or a start to a bull market that we've seen in decades, maybe ever. I went through global financial crisis, some of the big ones like the dot-com bubble as well, and some of the smaller ones, even some of the smaller pullbacks. Typically at the beginning of these things, and this would have been traced back to October because that's when we had the lows, everything goes up. And then you have a period of consolidation, pullback, people don't believe this is a new bull market, and then things start getting narrowed and more selective. What we did this time is we started the opposite way. This is assuming that we're still in a bull market, but the opposite way would be we're starting out with a few narrow names and now we're expanding. So it doesn't mean this doesn't have to be the case, but historically it would be very unusual. Couple more things I want to point out here. Indices are getting very stretched, even the S&P 500, which was not as stretched as the Nasdaq. If you take a look at the S&P 500 relative to its 50-day moving average, getting very well extended. Bespoke has a couple of notes and graphics out on this, but basically we could be due for a mean reversion, and that would just mean price either has to come down or price has to stay level and a correction in time has to occur. Haven't seen either of those things pan out just yet. Bottom line, market overall probably due for a pause or a pullback. Or what could happen is if this rotation continues, we could just see select pockets of the market advance while other ones take pauses. So all in all, we do have some momentum to the upside. We have this huge CPI report due out tomorrow. Going to be a lot of headline risk from that, as well as a Fed report. So enjoy today because things get a little messy starting tomorrow morning.
We will see. Thanks so much, Jared. We'll brace ourselves. Well, as we've been talking about, it's been a big year for tech. The sector roaring back to gain more than 30% this year alone, and the rally gaining traction on cost-cutting optimism and really AI buzz. Mega cap tech stocks taking the S&P 500 along for the ride. The recent buzz around tech and AI is giving some investors early 2000s dot-com bubble deja vu. After that dot-com bubble burst, the tech-heavy Nasdaq Composite plummeted from its 2000 high. Will we see a similar story with today's AI boom? Joining us now, Keith Lerner, Truist co-CIO and Chief Market Strategist. Keith, it is great to see you. And you have been looking at this analysis and parallel in detail here, and you had some really interesting findings, particularly around valuations then and now, and kind of where we are in this enthusiasm rally. So talk us through your thoughts here.
Sure, and good happy Monday, Julie. Great to be with you to start off the week. So yes, I actually started my career in the mid-90s around the technology boom. So every time you start to see some of these technology stocks really start to move, there's questions, is this like a similar backdrop to the technology bubble? I will say there are some echoes, meaning, back then, if you put a .com at the end of your name, you would see a pop in the stock. More recently, you see in the quarterly earnings reports, a lot of companies, talking about AI, whether they're using it or not, and it's contributing to movements. But I will say at this point, as we look at two things, valuations and returns, it's really not comparable yet. I'll give you an example, Julie. If you look over the last year for the S&P technology sector, we're up about 27, 28%. Heading into the peak during the technology bubble, we were up over 100%. On a 3-year basis back then, the market, the technology stocks ran over 350%. We're not even close to 100% on the last 3 years. And valuations are certainly rich, and you could argue they're stretched relative to the last 20 years, but they're about half the levels that we peaked out, back to the technology bubble. So I think to wrap that up, you can say things are rich, they're somewhat stretched, but I think a lot different than what we saw at the technology bubble, at least at this point today.
Even as things look rich right now, are there still areas that you're kind of a little bit more bullish on long term, where even though it seems rich, the return over an extended period of time, depending upon an investor's time horizon, could still look attractive?
Yeah, great question, Brad. Listen, we still like technology. We went overweight several months ago, along with communication services. And I think the reason why, even though they're rich valuations, where we're sticking with this area, even if they're due for some type of pause or consolidation, which we expect, is that, one thing that's changed and got us more positive is that the earning trends are moving up after moving down last year. And you got to remember, too, tech has had a round trip. We're down 34%. And we're off, we're up about the same off the lows this year. So you got to put that in context. But even if the economy slows down, which we still expect, our thoughts is that companies will continue to need to invest in technology spend or fear of being left behind. So we think that's a little bit of subtle difference, even in a weakening economic backdrop, that companies will prioritize tech spending, which will continue to support that area. But of course, Brad, I can go into other sectors as well if you like, outside of tech that we like. Let me know where you'd like to go next.
Well, I want to stick with tech for just another sec,
Okay.
Keith, if we could, because we do, we've been talking all about CPI and the Fed this week, but we have a couple catalysts more on the AI front, or at least potential catalysts, right? We have Oracle reporting, and we have AMD holding an investor day where they're expected to focus on AI. And I just wonder how much heft you think these types of news events are going to continue to have in this very AI-sensitive environment.
Well, I think obviously, people will continue to look at this and they want to see, as far as, is there a revenue generation? Right now, so far we saw NVIDIA actually with this big move up in revenues. Other companies are talking about it. I think investors want to see more of a direct line and say, is there a revenue and an income opportunity? So I think it is still important. The only thing, again, on a short-term basis, we've moved up a lot. We've had the news the last month around NVIDIA. So I don't know that they're going to be the market moving events that it would have been a month ago, because expectations are somewhat higher. But again, I think as we think about the next several months, next several years, AI is going to just be part of the discussion, throughout most of these corporate quarterly earnings seasons for the foreseeable future.
Well, when we think about that too, and it's clear that AI is kind of that next leg of the digital transformation, but even as we think about that digital transformation, what we've seen in the past is that in the cloud, you don't have a box that's going to be the same as an Amazon Web Services type of cloud storage capacity. Mm-hmm. There are not necessarily just winners and losers, but there are players that are miles ahead and have scale versus those that are just trying to look to benefit from the digital transformation, perhaps kind of offer a better price point as well along the way. So I guess all of that considered, even in this digital transformation, are there companies that could have the rug pulled as a result of having some big AI announcements, yet not being able to take on the same type of portfolio client base?
Yeah, no, you hit it right on, Brad, because what's somewhat different right now, a lot of people look for pure plays in this space, and the reality is there's a lot of infrastructure spend and capital that's needed, and that's part of why these Magnificent Seven, or whatever we call the top technology names, that's part of the reason why they're betting for it so much. They're not a pure play, but they have the capital and the infrastructure in order to push this ahead. And if we go back to the analogy of the tech bubble, we have to remember, the internet revolution actually happened, but there was many companies that didn't survive. Even, you could argue the king of the internet time was Amazon, and at some point that stock was down 70 or 80% after the aftermath of the tech bubble. Now it came through the other side, as we all know. So I think you're going to see the same dynamic as well. You're going to see a lot of companies that haven't, put an AI tag or have something specialty that are going to fail. But then we're going to see, other companies that prosper. I think the challenge in part right now is it's really too early to know who all the winners and losers are going to be. But in general, we still think the big cap tech will benefit, and part of the reason why we remain overweight the S&P technology sector, at large.
Let's broaden it out a little bit, Keith, because, you know, we've been having this sort of mini debate, if you will, about whether we're actually now in a bull market, right? And I guess the implications of that are whether stocks are going to keep running, if they're going to keep going higher. My understanding, I think you're neutral, if I'm not mistaken, on stocks overall. Talk us through your thinking here.
Yes, we are strongly neutral.
Strongly neutral.
Strongly neutral. I know it's a strategy. You like to have a big, banging call, but the reality is we're just seeing, such a conflict of data right now. And one of the things we said coming into this year is keep an open mind because of this pandemic and the way things have kind of moved forward. It's just different than the traditional playbook, which is being challenged. So, the way I would think about it is I think we're in this choppy trading range. I think the range has moved up partly because earnings are proving to be somewhat better than what we expected, and I think as the market expected as a whole. And then the other thing is I think technology will continue to hold this premium valuation. So for you to look for a big new low in the market, you have to be bearish on tech alongside a recession as well. So I think tech's going to hold up somewhat better. And I think really what we're looking for is relative opportunities because to have a big move up from here, I think it's somewhat challenging because you don't have the Fed go through a massive easing cycle unless the economy really weakens. Valuations are still at the high end of historical ranges. So we can label this a bull market, but I just think it's going to be somewhat different. And it's not the type of bull market that we became accustomed to coming out of 2009 low, the 2020 low, where you had all that fiscal stimulus, cheap valuations, and really negative sentiment. So I think it's going to be more of a choppy range with tactical opportunities. And right now, I heard earlier some your guests talking about this. We also think there will be some catch up in the equal weighted S&P. You had the worst relative performance since 1990. That's as far back as we have data. So we're likely to see some mean reversion, and then later this year go back to tech. But again, I think from our portfolio standpoint, we're sticking with the broad-based S&P, and we're having more of some of that equal weighted S&P just as a hedge for that mean reversion that we expect to continue near term.
Keith, great to catch up with you. Thanks for joining us. Keith Lerner, Truist Co-CIO and Chief Market Strategist. Thanks.
Thank you.
Coming up, a big week ahead. We'll tell you what you need to know to stay ahead of the game. This week is going to be a busy one. Lots of new data and major decisions to keep an eye on. You can expect to see the May CPI report and a new Federal Reserve decision on interest rates. We'll also be watching for data from the Producer Price Index, retail sales, initial jobless claims, and finally, we'll round up the week with the University of Michigan's Consumer Sentiment Index.
Coming up, though, more imminently, more market coverage, and we'll get a deeper insight into the economic outlook with UBS Global Wealth Management Chief Economist Paul Donovan. That's next. Hello, it's just after 10 a.m. in New York City. This is Yahoo Finance Live. I'm Brad Smith alongside Julie Hyman. We're 30 minutes into the start of trading here on this Monday. Let's take a look at what's moved since the market opened here. We're starting things off taking a look at shares of ORCL Oracle. The company gets set to report first quarter earnings after the bell today. Investors, they're going to be focused on how it's handling macroeconomic trends and if it's seeing success in its cloud business. Also worth noting, a Wolf Research upgrade to outperform is helping the shares ahead of that quarterly earnings report. The Wolf Research report actually anticipating a solid fourth quarter and also some AI tailwinds that Oracle could be the beneficiary of. Shares of Oracle up over 30% year to date.
And shares of Illumina are also on the move today. That's after CEO Francis D'Souza announced he will be stepping down unexpectedly. This, though, coming after pressure from Carl Icahn, to remove D'Souza from the position after after D'Souza pushed to acquire healthcare company Grail was shut down by regulators. Illumina says it will continue to execute on the company's goals while searching for a new CEO. But this does feel like potentially a victory for Icahn in his push there.
Yeah, spot on. We're also watching shares of Nasdaq here today. They are sinking this morning after announcing an acquisition of Adenza. This is a $10.5 billion even mix of cash and stock deal. This is the company's largest deal of its kind as it looks to expand its revenue beyond its exchange business here. Of course, it has several different businesses that it operates. I would say that as an alma of Nasdaq as well, across listings and IPOs that get kind of the flashy attention, but market technology more broadly internationally have helped the company also be able to expand. And also, of course, we've got some of the corporate solutions that they would look across, whether that's just deploying messages across the wire and other such elements of that business too. So this is the latest though.
Yeah, investors don't love it though.
They don't like it.
Let's talk about this week. From key inflation data on tap tomorrow to the Fed's much anticipated interest rate decision on Wednesday, we got a lot to watch this week. Yahoo Finance's Josh Schaefer is here to give us a full breakdown of which things we should be focusing on and how. Josh, tell us what to do.
Julie, so this week, we really don't have a lot on the corporate side of things, right? So we don't even have a corporate calendar with me this week. There's not a lot of earnings. That's not going to be the focus. What is going to be the focus is the econ calendar, starting with CPI and that important inflation report tomorrow. Then again, that's going to be the start of that FOMC meeting tomorrow. But then the press conference will come on Wednesday. We'll get the update on where we are with interest rate hikes. Does the Fed pause, which is currently what people have priced in? That is the expectation right now, is for the Federal Reserve to pause interest rates after increasing for the last 10 meetings. And then you move forward to Thursday, and we're going to get more info this week as the week carries on. Actually, we have retail sales on Thursday and University of Michigan consumer sentiment on Friday. But really the focus of the week is going to be CPI, because right now people have priced in, again, for the Fed to pause. But if CPI comes in hotter than expected, if inflation remains stickier than people think it will, then that maybe shifts the Fed at the last moment. So here's what we're looking at for May. Here are the expectations. Expected inflation to increase month over month at 0.2%. And the headline number here, 4.1%. The headline number last month, you remember, was 4.9%. So this would be a pretty big decrease. And that is obviously what the Fed wants. That's what we all want. I think it would be nice if prices overall came down, guys. So that's sort of what people are looking for headed into tomorrow's print. Again, if it comes in hotter than expected, that will be something to watch as the Federal Reserve meeting starts, because right now it seems like they're pretty happy with the path of inflation starting to ease. So if it doesn't ease, then maybe we see a surprise hike.
Right. Big week ahead. Thanks so much for teeing that up for us, Josh. Appreciate it. Well, as we look ahead to a packed week, kicking off with inflation data tomorrow, Tuesday, our next guest says that we are in the third wave of post-pandemic inflation. Paul Donovan, UBS Global Wealth Management Chief Economist, joins us now. Paul, good to see you here this morning. We're excited for this week. I know you are as well. As you think about what the Fed would need to see within this CPI report to ultimately feel like the economy is digesting some of the activity that they've put forward, where are you going to be looking most specifically within a report like the CPI one and the print that's set to come forth?
Well, I'm afraid with the Powell Fed, the obsession is just with the headline number and the headline core number. I think this is a mistake. I think you really do need to look in at the detail to get an understanding of where inflation is going to go. But Powell's response is very much economics 101, inflation high, raise rates, nothing particularly in depth about it. I think when we look at the core number, which is where a lot of the attention is going to focus, we need to see how wide the inflation is going to be. So there is an expectation that nearly all of the inflation in the core number is going to come from used car prices and from owner's equivalent rent, this very fictional housing measure, which nobody actually pays. Now, the reason that matters is, of course, most people are not buying a used car this year. And nobody pays owner's equivalent rent. It's an entirely made up figure. So actually, a lot of the inflation in the core number that's being reported isn't actually affecting people's cost of living. That's going to be an important point in stabilizing growth later on this year.
And so, Paul, when we're looking at where inflation is coming from right now, especially if those numbers are not really capturing what is sticking around, where is it coming from right now?
Well, so we've had a really unfortunate situation where we've had three very, very different inflation waves caused by very different things, and they've just come one after the other. So it looks like you've had this sort of continuous period of inflation. But the first wave, which was about consumer durable goods, that was demand-led. That's over. I mean, durable goods prices in the States are falling. You've got outright deflation. You've had outright deflation now for 6 months in durable goods prices. The second wave of inflation was supply-led, and that was the energy shock coming out of the war in Ukraine. But then the third wave of inflation, the one we're getting now, is this unusual profit-led inflation story. Now, to be very clear, this is not the entire economy. This occurs where firms towards the end of the supply chain, so that's consumer-facing companies or near consumer-facing companies, increase margins and pretend it's all due to costs and other factors. They sneak in a margin increase. And you can see this with, for example, the rise in retail profits as a share of GDP. That's one instance where we're seeing this expansion of margin under the cover of, oh, it's a general inflation problem, we can't help it. But actually, they're expanding margin and just basically persuading consumers to accept that.
Okay, so that sounds like excuseflation, if we can put it that way?
I guess so, yes. I prefer profit-led inflation, but that's because I'm an economist and British, so we're very precise in our language over here. But yes, it's using excuses. It's using a cover. Now, it doesn't last forever because at some point, either governments or consumers realize that this is going on, and they say, "Hold on, that's not fair," and then you start to damage brand values, and you're seen as cheating or unfairly treating the consumer. And that's exactly the point that we're now starting to get to. So just on Friday, the French finance minister announced price cuts in the food sector because they've been focusing very much on this profit-led inflation. They're saying either you start cutting prices or we're going to do something about it. Similar pressures in Spain. Here in the UK, we've had a similar thing. So we're starting to get to the point where this profit-led inflation is really coming under pressure. And those margins in the retail sector and near the retail sector, I think, are going to start being squeezed.
Yeah, I mean, this is a really fascinating concept to me that you talk more about in your note. And you also talk about the idea that maybe in this modern era, social media can play a role in pushing back against price increases. And is it just sort of that collectively it gives a way for people to complain publicly and there's sort of transparency in pricing?
So I think it works both ways. So on the way up, of course, what we had, you cast your mind back to last year, these terrible stories about the situation in Ukraine and awful images coming through. And so when companies say, well, the problems of the Ukraine, the war are causing us to raise prices, we accept that because we're seeing this so visibly on our social media. But then social media does also allow people to complain, to damage a company's brand. If you've got the wrong hashtag trending, then your brand is going to be damaged. And if you're being accused of profiteering, of excess profit margin at a time when people are really suffering. And remember, we've had 2 years of negative real wage growth across the developed world. People are feeling the pain, and you don't want to damage your brand in the long term if social media is starting to attack you. So I think that social media can help inflame profit-led inflation by creating excuses that companies can use, but it can also work by threatening brand values to cause companies to rethink some of their pricing strategies.
Paul, hang around for just a moment because there is another topic we want to turn to with you, and that has to do with China, which is now facing a COVID resurgence. Positive test results rising to 40% in May. That's according to government data released over the weekend, and it's the highest level the country has seen since January. Obviously, there has been a lot of attention continued on China's economy and the implications globally as well. Paul Donovan, UBS Global Wealth Management Chief Economist, is still with us. And Paul, not only, because Chinese consumers are a powerful force, right? Because they travel as well, but also because of the importance still in the supply chain. So how should we be thinking about this latest wave in China and whether it is going to have a big impact?
So when an economist looks at something like a pandemic, we are not necessarily interested in case counts and things like the virus, whilst that can obviously be very traumatic for the individual. Economically, what matters is fear of the virus, because fear is what changes behavior. So the question is not, is the case number high? The question is, are people changing their behavior as a result of this? And I think if we look back over the course of the last 3 years, fear levels have shifted. The prevalence of vaccinations, improved treatments mean that fear levels are generally lower. So we now need to look ahead and say, okay, are people's behavior patterns changing as a result of this situation? And if they're not, the economics of this is fairly negligible.
So
when it comes to the Chinese economic revival, this has actually been quite parochial. It's been quite inwards looking. So the focus has been very much on domestic service spending. Understandably, I mean, families have been kept apart for 2-3 years. People are traveling around, seeing friends and relations. So in that situation, the impact of China's reopening on the global economy has been quite muted because it's domestic restaurant meals, internal flights, rather than buying goods or traveling abroad, both of which would have a greater external impact.
China and India were looked at as the two economies that would be driving most of the GDP growth over the course of this year. And so do you think revisions now need to be put forward?
Well, so the thing here is that when we look at global growth, I mean, global growth is just a weighted average, and China, India, just by the size of their populations, have a large weighting in that. But actually, what really matters most of the time is the way in which China or India are growing having an impact on exports from the United States or exports from Europe, because that then transmits the growth through to those economies. And as I said, because the Chinese growth revival has been quite inward looking rather than external, there's not been a huge amount of international travel. They've not been focusing so much on purchases of goods. It's more been about purchases of domestic services. The impact has not been that great on other countries. So if the question is, do we need to revise US GDP estimates because of what is happening in China? The answer is probably no. If we are talking about a global growth aggregate, then yes, obviously that will go up and down with China's growth number because China is a significant sized economy. But the transmission to other economies, I think, is relatively limited at the moment.
Is there anything that's going on now geopolitically between the U.S. and China that would lead you to tweak your estimates, or that you think especially bears watching? I believe the latest today was a story out of the Wall Street Journal that said the U.S. is going to allow, for instance, companies based in Taiwan to also operate in China without some of the restrictions that are on Chinese-based companies.
A lot of the geopolitical stuff at the moment, it's of a level where it affects individual companies, but it's not necessarily transformative in terms of the trends that are already established. Things like localizing production, these are underway for sound economic reasons. It becomes more efficient to produce closer to your consumer. Technology changes, and no one is making large numbers of compact discs in China anymore because nobody uses compact discs anymore. So you're seeing these changes come through. So we're getting a certain amount of noise, and for individual sectors or individual companies, that may well matter. For the broad macroeconomic picture, I don't think at this stage we're seeing anything which is changing the general trend of direction.
Paul, thank you so much for spending some time with us this morning. Paul Donovan is UBS Global Wealth Management Chief Economist. Thanks again.
Thank you.
Coming up with the latest indictment out in the open, are former President Trump's 2024 dreams over? We're going to take a look at the political landscape next.
Curious about what's going on in the housing market and whether or not it's a good time to buy this home or another one? We've got you covered. We've got a jam-packed week filled with experts, including real estate agents from across the country. We'll also get a temperature check on the state of home building and whether or not it's a good time to stack up on those home builder stocks. We've heard from home builders that they're capitalizing on the housing shortage. We'll also tap into commercial real estate. Is it doom and gloom after all? And can't forget, we'll hear from the real estate queen herself, Barbara Corcoran. Tune into Yahoo Finance Live all week long.
The indictment against Donald Trump marks the first time a former president has faced federal charges, but there's no clear path ahead for what this means for his presidential campaign. Trump is currently leading the GOP nomination contention, and on Friday, Yahoo Finance hosts Akiko Fujita and Shauna Smith spoke with James Carville, political strategist and host of Politics War Room, about what the indictment means for Trump's 2024 aspirations and the future of the GOP.
If you do what I do and spend your time listening to Fox and right-wing radio, you would think this was the equivalent of a failure to yield a right-of-way violation. I'm more interested in the political ramifications of this. And it seems to me that any Republican who veers into thinking that this is a serious issue that compromises national security is not going to fare very well among other Republicans. And I think that's one of the more interesting aspects of this case. The politics of it are going to be just stupendous to watch.
Yeah, James, talking about those political potential ramifications there, ahead of these charges, Donald Trump was viewed as the leading contender for the GOP nomination for 2024. Does this change that at all?
Yeah, I wish I knew what the Dow was going to do a month from now. It looks like the initial reaction is to rally around the flag, clearly among Republican commentators, among right-wing elites. There are some people that are even suggesting that other people shouldn't run against Trump for the Republican nomination. That seems to me to be quite extreme. I don't think Chris Christie is going to listen to that, but there's going to be a backlash, and they're going to have to answer the question everywhere they go: will you pardon Trump? That's going to be that is the number one question that Republican presidential candidates are going to have to answer from now going forward. And I really don't see this. I don't know if it's going to change. If some Republican voters will be upset about it. 37 counts, according to people who know something about this, these are pretty specific and pretty substantial allegations that are being made. But I'll leave that judgment to others. But for the politics of it, it's going to be a fascinating ride.
Well, and we've already had a number of GOP presidential candidates who've essentially sort of suggested that he will be pardoned if, in fact, he is found guilty on these charges. I mean, does that tell you the hold he still has on the party? And does that essentially answer that question you just asked, which is, will this even make a dent in his support within the party?
Well, it's certainly not going to make a dent with his hardcore support, if that's 45% of the party. But the Republicans can't win without the hardcore Trump people. And they will demand, and I suspect they will get pledges from all of the major Republicans that they'll pardon Trump. Now, as these facts come out, they're going to be very difficult. But if you listen to right-wing radio and Fox News, which I do, and by the way, most of my friends who are substantial in this business are listening to Fox and right-wing radio, you hear more talk about the Biden crime family and Hillary's emails than you do about, showing people national security secrets. So it's going to be fascinating going forward here, I promise you. And, and these things are developed. I would say, I think one of the most important events coming up is the trial that Trump is facing, we're forgetting about this, in Manhattan in March of 2024. That's being sort of sloughed off and lost in the shuffle here. But if there's a guilty verdict there, that could change equations. By the same token, if he's found not guilty in a Manhattan jury, that would change equations the other way. But I think that event is kind of being underplayed in the national media in terms of its certainly political significance and maybe even legal significance.
James, when it comes to the political significance of this, what about the fallout beyond the presidential race when it comes to the GOP in the House and in the Senate, with all the focus here, much of the focus on these cases that Trump is facing and not on the Democratic rival, the runner that he or one of his GOP runners will end up going up against?
Well, that's a very relevant and a very smart question, because if you're running for the county commission, I'm here in solid red Shenandoah County, Virginia, you're going to be asked about this. This is going to be a litmus test. But if you're running for the Senate, or if you're running for the House, it's really going to be front and center. But I don't think there's a Republican candidate in a primary or even a general election that's going to be able to escape this question.
Well, it's not clear yet if the charges against the former president would bar him from holding office. The situation is unprecedented, as we have been saying. But constituents don't seem to mind. An overwhelming 80% of GOP voters in one survey saying that Trump should still be eligible for the presidency, even if convicted. That's according to a CBS News YouGov poll. Joining us now, Steve Clemons, Semaphore founding editor-at-large, and Tobin Marcus, Evercore ISI senior U.S. policy and politics strategist. Guys, thanks so much for joining us. Steve, I'll start with you here, because we're talking about a long road for this whole situation, right? And still a long road to the next election. So how should voters, how should investment professionals, for that matter, be thinking about this indictment?
Well, the true answer is they shouldn't be listening to any of us. They should be reading the indictments themselves, look at the material, and watch the court process, the legal process in America play out. A lot of us are trying to game what might happen, how Donald Trump might respond. What's the red line for Republican voters who, as you just pointed out in one CBS News poll, Donald Trump looks unaffected. There's another CBS News poll that shows 75% of the likely GOP voters either feel like there's no impact on their decision, or their favorability towards Trump actually increased. So as we're gaming all of this, which is largely a political question, as your previous guest just said, there's a legal process underway, and it's going to take some time. And there are other legal processes from Fulton County, Georgia, another decision from Jack Smith, likely with regard to Donald Trump's activities on January 6th. There's a lot of stuff coming out, and voters should go to the substance and make judgments from that.
Tobin, what about you? Does this move the needle at all for voters?
In the primary, I think the answer is no. I agree with Steve and with James that, if anything, we're seeing a rally around the flag effect. I think the fact that all of Trump's would-be challengers, with the lone exception of long shot candidate Asa Hutchinson, either totally accepted his kind of witch hunt frame on this and characterized it as weaponization of law enforcement, or from the more Trump critical folks, couldn't bring themselves to go beyond just saying, let's wait for all the facts to come out, let's allow some time, let's unseal the indictment and get a look at the details. Really tells you everything that you need to know about the willingness of anyone in the party and the political attitude of anyone in the party to buck the kind of party line on this. In the general, it's a very different story. I don't think that the marginal Republican voter in the general election is going to be someone who is not rock solid loyal to Trump or rock solid loyal to the Republican Party. And those folks at the margin, I think, are going to have valid concerns about this. The indictment looks quite grave. I can't imagine that the way that it plays out between now and then, not just this case, but, the other forthcoming indictments and the trial in the Manhattan case are, I think, going to alienate some moderates and swing voters who the Republicans might plausibly need to get over the finish line in the general.
Yeah, Tobin, this is something that our Rick Newman has maintained throughout this, that, there were definitely a cohort of sort of classic Republican voters who held their noses and voted for Trump because they wanted the sort of historical lower taxes that, are reputed, if not always enacted, by the Republican Party. And you do wonder, Steve, if that changes the calculus this time around.
Oh, you're saying, Steve? Well,
Sorry.
I think that what changes the calculus this time around are the number of, just the legal quagmire that Donald Trump is in. I think Tobin gets exactly right. He's got a path that remains very wide to the GOP nomination. But after right now, if we're held tomorrow, he would secure that GOP nomination. But when it comes to the general election, I think he has some real problems. And when you think you're asking about crossovers, I interviewed a bunch of billionaires once. who are Democratic billionaires and Republican billionaires. This was during the Trump administration. I said, is Donald Trump friend or foe? And for all of them, they said friend. They said he has reduced taxes so substantially. He's made the American economy globally competitive again. And that made a real difference for them across the board. But when you have someone with the legal pileup that he has right now, it begins to raise the question, or at least I would think among some Republicans, is does their franchise, rise or fall, and all of their prospects rise or fall based around this individual? And I think Tobin is right. Many of the weaker affiliated Republicans and certainly independents are in much more shaky territory when it comes to supporting a Donald Trump candidacy.
And yeah, just as we kind of think about how this has played out, even in some of the recent elections, whether that is the general election in 2020, whether that's the runoffs, whether that is the midterm elections, there hasn't been as much of a red wave riding on the back of an endorsement from Donald Trump for some of those candidates as was anticipated. And so in place of a wave and there instead being a ripple, how much does that begin to wane in terms of some of the effectiveness, even though we are taking a look at some of the polling numbers, which you can do what you will with polling at this point going into many of these elections? Steve? Yeah, Tobin, go ahead.
Oh, sure. I was going to say the results of the midterms, I think, are really instructive here. Democrats won independents by 2 points in the midterms, which is extraordinarily rare in a midterm election for the president's party during that president's first midterm to win independents. And I think that just goes to show how important persuasion still is in the modern electoral landscape. A lot of politics in recent years has been about base mobilization, and that game of kind of getting your base riled up and turning out your respective side is hugely important. But there are a lot of persuadable voters in the middle still, frankly, on whom the election will swing. I fully expect that both Biden and Trump would go into this election with high unfavorable numbers, and there will be a lot of voters who are looking at two candidates they don't like and having to choose among them. But there will be many of them who look at this legal morass and think that the reasons they dislike Trump are a lot more serious than the reasons they dislike Biden.
Tobin.
And what I would add to that,
ahead,
if I may, is that while Tobin is right that you're going to have with two flavors of ice cream, if you will, in the end. One of the things we saw in the midterm election was essentially, in my view, a real weakness of the Democratic Party, which was being dependent on the Roe v. Wade, on the Dobbs decision, on being dependent essentially on the January 6th narrative. Now, these are genuine issues. It's the solvency of American democracy and the solvency or not of women's rights in this country, as opposed to an agenda that is driving them forward. And I think one of the really interesting challenges out there between the parties, say what you will about Republicans, they have the Supreme Court. They've moved a 6-3 majority on that court. They've achieved a lot when it comes to abortion rights, and they're able to show that and basically say our franchise is delivering to you regardless of how crummy our leader might be. And so I think it's very important to remember that if you have a candidacy depending on the other side doing bad things versus what your focus is, that's also going to be part of the environment. I don't know how it's going to play out, but I think it's often an overlooked part of the competition between both parties.
Well, I think that Democrats could reasonably argue that they have delivered on a lot of their agenda, with the exception of something like Roe v. Wade. They just haven't done a great job of the strategic messaging, of that part of it. Finally, Tobin, I just want to ask you, again, to bring it back to the markets, right, which is our bread and butter here, and investors, what they should be paying attention to here, or can they just not pay attention until we get a lot closer and further along in the presidential race before they can start to sort of game out what effect it could have on the markets?
Yeah, I mean, look, there's a near-term set of questions around kind of acute turmoil in response to the legal milestones in these cases. I tend to think that the risk of that is relatively low. Certainly in the Manhattan case, there was some kind of sound and fury, and then ultimately we had more journalists than protesters at the arraignment. We'll see how tomorrow goes. The volume of that could increase, and that could be a concern for markets. But I will largely, I think we'll kind of wait to see that before getting concerned. Looking further down the road, I think there are differences between Trump and the rest of the Republican field on issues like China and issues like conceivably, interest in trying to repeal the drug price negotiation pieces of the Inflation Reduction Act. And so anything that moves the primary one way or another, I think is relevant in those terms when you're looking at the long-term valuations for some companies that are exposed to his kind of policy idiosyncrasies on those dimensions. But for now, looks like he's quite firmly in control in the primary, probably more than ever. And then, looking at the general, there is a huge amount of fiscal policy depending on who wins next year, with Republicans proposing $3.5 trillion plus in tax cuts from extending the expiring pieces of the Trump tax cuts, Biden probably wanting to extend those below 400,000, let them expire above, and of course a wide range of regulatory matters across the government, particularly in energy, but really across the board. So any of these things that are shifting people's assessments of the general election landscape are, I think, hugely important when filtered through that lens.
All right. Well, we will continue to track to see what moves the needle for voters as well as for investors on that front. Tobin Marcus, Evercore ISI Senior U.S. Policy and Politics Strategist, and Steve Clements, Semaphore Founding Editor at Large. Gentlemen, thanks so much for taking the time this morning.
Thank you.
Absolutely. Coming up, we'll be taking a look at sliding oil prices and a big call from Goldman Sachs. That's next. Bank of America is out with a note today upgrading its sentiment on Carnival Cruise Lines to buy from neutral and raising the cruise line's price target. Joining us now, Yahoo Finance's Shauna Smith to break it all down for us. Hey, Shauna.
Hey there, guys. All right, let's talk about Carnival Cruise Line because certainly a winner in today's action. We're looking at gains of just about 12% so far. Two bullish notes out on the cruise line here, Bank of America and also JP Morgan. So taking a look at those new price targets that we just got here from the banks this morning, JP Morgan raising its price target target to $16 a share. Bank of America nearly doubling its price target to $20 a share. Bank of America, in its note that it just released, laying out a base case as to why they are bullish on the cruise line. Now, among those reasons, one, they're saying that the recovery that we're seeing right now among the cruise lines, that they believe that that recovery is stable. Balance sheet is also being reduced. We'll talk a little bit more about that in just a minute here, but also valuation does not look stretched on any metric. And when we take a look at the price action that we are seeing in the stock today, we are seeing a bit of a jump up here with shares up just about 12%. The move higher this morning here, taking us to the highest level that we have seen in just about a year, hitting a new 52-week high, so just over a year, up just about 33% over the past year. Some of that improvement there, the reason why Bank of America is so bullish on Carnival is because they're saying that it's trading at a discount here, 8 times relative to earnings than compared to some of its peers. When we talk about the recovery that we are seeing, not just at Carnival, but really across the board, Yahoo Finance's Brian Sozzi sat down with the CEO of Carnival, Josh Weinstein, earlier this year at Milken Conference, talking to him about some of the trends that he is seeing in the industry. Let's take a listen to what he had to say about that demand.
We had record numbers, right? We just got through the wave period, which is the highest booking period in the industry. We literally had the most bookings in the history of our company in that 3-month period. And that was both our North American brands and our European brands, which took a little longer to get back into that flow. So frankly speaking, between that and our first quarter results, where we beat on every single line item, things are trajectorying in the right trajectory.
Bank of America and JP Morgan, both those notes going on to say that they aren't seeing any signs of softness, at least just yet. I mentioned one of the reasons why Bank of America is bullish on Carnival is because of the improving balance sheet here. And also in that discussion with Weinstein, he did discuss the current debt levels. We know that has been a bit of an issue or a challenge here for the company, also something that investors have been focusing on here. In terms of what he did say to Sozzi back during that interview, he said that they're starting to pay it down and there's no intention of issuing more stock. So taking a look at the last 2 years within the stock, still off 50%, so well off the highs that we have seen over the last couple of years. But guys, demand for cruise lines certainly goes with the broader trend that we have seen across the board when it comes to travel. People are willing to spend. People are getting back on ships. So we'll see whether or not if that trend continues.
Yes, as we were talking about earlier, not us, but lots of people are into it.
I know. I haven't gone on one yet. Maybe in the future.
Yeah. I did one
Did you like it?
No, not really. All right, thanks. That was a long time ago. Goldman lowered its outlook on Brent crude oil to $86 from $95. The investment bank slashing its oil price forecast by 10% due to news that Saudi Arabia will be cutting oil production by another 1 million barrels a day. We're joined now by Yahoo Finance's Inez Ferreira to learn more. I mean, we already knew about the oil production cut. We are seeing oil prices move down today. So what's going on here?
Yeah, that's right. And this is significant because Goldman Sachs is normally seen as bullish when it comes to oil. But this is their third revision in the last 6 months with oil prices. As you said, Julie, Goldman Sachs now predicting that oil will reach Brent, will reach $86 a barrel by December. That means that by December, that's the cost for the end of the year. And for WTI will be sold at $81 a barrel, according to Goldman's prediction. That's down from $89 a barrel. Now, why this? Because of supply beats. This is despite, as Julie's just mentioning, Saudi Arabia's output cut announcement, its recent output cut announcement, and also sanctioned countries like Russia, like Venezuela, like Iran, and their oil entering the market. Also, you had the China lockdowns last year, which really put a damper on oil prices, but that recovery in China hasn't been linear. And in fact, Goldman Sachs over the weekend also put out another note on China and their property, the property market there, and how depressed that still is and how that's going to be a multi-year drag on China. So you can imagine that all of these factors are having an impact on demand. Recession concerns, of course, are something that, of course, has been mentioned before. But look, $87 a barrel was Brent crude on April 12th. That was just a couple of months ago. And you'll recall that at the beginning of April, you had OPEC Plus announcing a surprise production cut. And exactly 1 year ago, Brent crude was trading at around $120 per barrel. It's at $71 a barrel right now. So extra supply And look, when OPEC Plus says that it's cutting, they want to put a floor on these prices, but they're also looking at demand going forward.
Yeah, but it looks like the ceiling is not going up, at least according to Goldman Sachs right now. It'll be high, according to their forecast, higher than it is right now, but definitely not reattaining.
Not as bullish as they have been in the past.
Yeah, definitely. Well, hopefully we'll catch up and get more from them soon. Thanks, Ines. Appreciate it. Coming up, a leadership shakeup at Illumina comes on the back of pressure from a big activist investor. Anjali Kamlani will have the details next. Illumina CEO Francis D'Souza has officially stepped down. That follows pressure from Carl Icahn to remove himself from the position after D'Souza's push to acquire healthcare company Grail was shut down by regulators. Yahoo Finance's Anjali Kamlani joins us now with the details. Even though there's been this pressure, this was still unexpected news, especially since it follows after earnings.
That's right. Not only earnings, but also from the win that Francis basically faced, not losing in that proxy battle back in May, which ousted the board chair, John Thompson, at the time. So what we saw then was shareholders voting for one of Icahn's three nominees for the board, and CEO Francis D'Souza surviving that, but now stepping down as Carl Icahn continues to put pressure on the company to divest the Grail assets. So what happened with Grail? Just a recap on that. The company had first divested that, or rather spun it out back in 2016 for about $2 billion. The company then looked at reacquiring it, announcing that in 2021 for $8 billion. Regulatory decisions had not yet been complete by the time Illumina wrapped the deals, both in the US and the EU. They faced blocks, concerns about market competition being the major point there. And it's really costing Illumina a lot of money, about $800 million a year, just to hang on to it, according to reports. So that's sort of where the concern comes in and where you've seen the pressure mounting from Carl Icahn. So this essentially ends that proxy battle and the pressure there, but they still face the decision of divesting Grail moving forward.
Anjali, we're also watching another story in the healthcare space. Novartis, they've agreed to acquire Chinook in a $3.5 billion deal here. What can you tell us about that?
That's right. So Chinook is a kidney disease company. They have 2 treatments that they've got in the pipeline, clinical stage. This is really a good target for a company like Novartis. We know a lot of these large pharma companies are looking for the rare space as pressure mounts on them from things like the Medicare drug pricing negotiations. They've been looking at areas where they can really ramp up, disease stages and assets that won't necessarily be targets of those negotiations. We know Novartis earlier this year announced that it was going to cut back on its pipeline, and that included on the cancer side. So this definitely builds up and bolsters its pipeline a little bit, and it'll be interesting to see what other moves it makes to make up for the cuts it announced earlier this year.
Anjali, thanks so much for tracking these stories for us, helping us break down the latest and greatest here in the healthcare landscape. Appreciate it. You guys, coming up, we've got more market coverage. We'll also be joined by our very own Dan Halley to discuss his take on Apple's new MacBook. Stay tuned. Apple's Worldwide Developers Conference 2023 saw the introduction of many new Apple products. Of course, there was the release of the company's first VR headset. But one product which grabbed a lot of headlines was the new Apple MacBook. And Yahoo Finance's Dan Halley, who was lucky enough to attend the event, seems to have snagged that very laptop. He just stole it straight from the premises.
Just walked away. Tim Cook said, "Hey, get back here." And I said, "No, sir." Yeah, this is the new.
No, sir.
I saw him at the event, people like following him around, and his security guards are very scary, so I did not do that. Yeah. This is the 15-inch MacBook Air. This is brand new, as you can see. You got this cool midnight color. I got some schmutz on it already, though, so I'll have to clean that off later. This is incredibly light laptop. Apple says it's the thinnest 15-inch laptop around. The big deal about this is that people have been wanting a MacBook Air in the 15-inch size for quite a while. The only thing that they have right now from the Air line is the 13-inch, and people just want something that has a little more screen real estate. And prior to this, if you wanted a larger screen, you could go with the 14-inch MacBook Pro, starts at $2,000, or the 16-inch MacBook Pro starts at $2,500.
What about that one?
This bad boy, well, it's $1,300. So, calling this affordable, that's a bit of a stretch, but it is a good deal when it comes down to it. Now, what do you get with this and what's the big deal? So this is running Apple's M2 chip. This is the chip that's going to offer better performance than you would get out of the old Intel MacBook Air. 8 gigs of RAM, 256 gigabyte solid state drive. That's, I would like it a little bit higher for the price, but you do get incredible battery life out of this. Apple says it's up to 18 hours. I've been using it just as my general, daily driver, and it really is astonishing. Got to caveat that with my current Mac's battery is like on its last legs. Like I got a warning that says replace it, and I've already talked to IT, and they're doing that. But this also comes at a time where Apple is trying to kind of reinvigorate the Mac line, right? Just because of the downturn that we had seen throughout the industry, where, I had said this in previous segments, but according to Gartner, they saw a 30% year-over-year decline in first quarter PC shipments worldwide. And then Apple also saw a year-over-year revenue decline in the Mac category from $10.4 billion to $7.2 billion in Q2. So this is part of their effort to really drive that forward. It's a product that people have been asking for a long time. You get a bigger screen. You're not paying $2,000. You're paying $1,300, but okay. But it is still something that I think a lot of people are going to like. And frankly, my wife and I are trying to fight over who's going to buy it.
Interesting. Can I hold it?
Yeah, go for it. Yeah.
So the other thing, how it's interesting that battery life is such a selling point, because to me, at this point, battery life with the phone, fine, because you're out and about. You're not walking around with the computer, and pretty much everywhere you go now, you have a place to charge your computer. So it's interesting to me that is still such a focus for the PC makers like Apple.
I mean, it's supposed to be a portable device. And, if they can't market it as such, then what's the point? Might as well just have a desktop. But
we're just going to pass the thing around.
I think one of the other things is if you look at it, it's got the MagSafe charger. So if you have a dog that runs past, it won't pull the entire thing on the ground.
Nice.
Not the case with that one, which has the USB-C. This also has two USB.
I saw that.
C ports.
I plugged this one into it.
Yeah, and it'll charge it. Both will charge it. The USB-C and the MagSafe charger. Problem is, there's only 2 ports.
There's no trackpad on this, I noticed.
Oh yeah, we got it right here.
Oh, not the, but the
no touchpad. Yeah. There is the Touch ID if you want to unlock it with your fingerprint. Okay. I can do that, no problem. You can also use that for purchases. But yeah, it doesn't have the whole touch bar, which was just like kind of a failed experiment that Apple did. And I mean, I enjoyed it to a degree. Like rewinding music from there was really cool. But I do appreciate not having to deal with that.
My computer doesn't even have that. I never even noticed. I guess the remaining question is if PC sales are down, is this going to convince people to buy PCs if they weren't going to buy it? But I don't think we have time to answer that question today.
I'll say maybe.
Maybe. Fair enough.
All
right. Thanks so much,
Strong
Dan
neutral.
Halley. Appreciate it. Bringing it into the studio for us. One programming note for you. Is real estate still a good investment for your money? We've got a week-long series kicking off today. Real estate, the new reality. We're going to speak with experts from every part of the market to answer your questions. You don't want to miss that. Rochelle Okufo's got you for the next hour of trading.
It's going to be fun.
Welcome to Yahoo Finance Live. It's 11 a.m. on the East Coast, 8 a.m. on the West. I'm Rochelle Akufo. Here's a look at what I'm watching this morning. Tomorrow's inflation data and Wednesday's Fed decision will grab investor focus this week. A strong CPI number for May would reinforce the idea that the Fed has a lot more work to do in cooling a resilient economy. We look ahead to a make or break report. And investors seem convinced the Fed will pause, but there's less certainty on the outlook for stocks. Wall Street has weighed in, with Goldman Sachs lifting its year-end target for the S&P 500 to 4,500. Morgan Stanley, though, feels differently. We'll break it all down for you. And Donald Trump makes his way to Florida ahead of an appearance before a federal judge on Tuesday. Speaking at several rallies, he said the only good thing from the indictment were his poll numbers. Well, they certainly haven't been hurt. We'll tell you where this could all go coming up next. But first, let's check in on how the major indices are faring an hour and a half into the trading day. A narrow trading range here. We're seeing the Dow here up just slightly, about 0.1% or 44 points. The S&P 500 there also up by about 0.25%. They were seeing tech as the biggest driver so far. The only laggard that we're seeing, at least the biggest laggard, is energy for the S&P 500 right now. The Nasdaq also up about 0.5% or 68 points. Let's also check in on the Treasury market. We'll see the difference between what we're seeing with bond yields and what we're seeing with the rest of the broader market. We're seeing the 5-year there up slightly, about 0.4% there. The 10-year also up 0.7%, and the longer-term 30-year yield up 0.7%, just barely there. All right, well, tomorrow's inflation data and Wednesday's Fed decision will steal investor focus this week. A strong CPI number for May will reinforce the idea that the Fed has a lot more work to do in cooling this still resilient economy. As ever, the core figure is in focus. Headline inflation has gradually edged down, but the reading excluding food and gas has been sticky and is likely to stay well above the Fed's comfort zone. Investor bets are in for the central bank to pause hikes for the first time in 18 months, but call it a hawkish pause. Let's bring in Richard Duchazal, William Blair macro analyst, for more. Thank you so much for joining us this morning. So, as we're looking at what the markets are expecting versus what the Fed may do, are we still looking at a pause and a pivot versus a pause and a hike, more of a skip in this situation?
Yeah, I think that previously, sort of maybe 2 weeks ago, it was kind of looking like a pause, and then the Fed maybe just stop there and no more rate hikes going forward. I think over the last few weeks, we've seen stronger payroll data, inflation a little bit stickier on some of the different measures. We're now sort of changed that pause to more of a skip. So the Fed this week on Wednesday, it looks like it'll probably pause or skip. And then the probability of another rate increase taking place in July has actually picked up. So if you look at, market-based probabilities, there's about a 25% probability that the Fed raises rates this week. But if you look out to July, that's increased to about 53%.
So then as you look at some of this other macro data that we're going to see this week, I mean, we've got CPI, PPI, initial jobless claims, retail sales, Michigan consumer sentiment. What sort of position does this put the Fed in when you have this, what could be considered a make or break CPI print coming up?
Yeah, a lot of data this week. I think, on the goods side, if we look at what we're expecting for the CPI, I think we're going to start to see some better numbers this month and in June. The comparisons compared to last year are much easier. So if you remember back last year, following the invasion of the Ukraine, inflation peaked at 6.9%. Back in June. So that makes it an easy comparison for May and then for June coming next month. I think what we can see for this month is, because as you mentioned, energy prices have been coming down, food prices have been coming down. So we're looking at a more moderate headline number of inflation. So in the previous month, we had a 0.4% gain. I think this month it'll be 0.1%. And then we'll see that headline number coming down quite significantly. On the core, things are a little bit stickier. So Powell likes to look at his 3 inflation buckets. So he likes to look at durable goods prices, he likes to look at shelter prices, and he likes to look at the services component ex shelter. And I think what we've seen there is higher rates have been moving through the economy and having the sort of impact that you would expect. So we've seen durable goods prices come down quite significantly. What we haven't yet seen is much give or much decline on the services less shelter component and the shelter component. But again, I think on both of those, I think we should start to see some disinflationary trends coming through as well. So for example, on the shelter component, we know some of the more forward-looking indicators like the Zillow rent price index or the Fannie Mae rent price index. Those tend to lead the Bureau of Labor Statistics, the CPI's rent component, by about 8 to 14 months. And those are coming down quite sharply, which should start to feed into the CPI shelter component in the coming months. Similarly, if we look at the services component, excluding that shelter component, if we think that that is largely based on wages, say, for example, CPI for haircuts, wages seem to be moderating as well. We had a conference last week where we had a lot of companies and staffing related companies, and the consensus amongst a lot of these companies was really that 2022 had been a catch-up year for wages, and now that's kind of done, and pressure there is starting to moderate. So I think similarly, services wages component, it's a lagging component, but I think we should start to see some good news coming through there as well.
So then for investors who are trying to look for some direction here in this pausing phase for the Fed then, I mean, you have the VIX ticking up today, but you're still seeing tech ahead today, and then also taking a look at what we're seeing with the action in the bond market. What do you think is the best indicator then of what's going to happen to the economy next?
Well, typically the bond market is going to be the most sensitive to macroeconomic data. I mean, the equity market is a good indicator, but it's not quite as sensitive to the pure macro data as the bond market is. I think we'll probably see a little bit of volatility coming through into the second half of this year. We have a lot of sort of conflicting forces. The Treasury has to rebuild its Treasury general account, its savings account that it held at the Fed, which was run down during the debt ceiling. So most of this year, it has to rebuild that. That's going to put a little bit further pressure on yields to stay a little bit higher than perhaps they otherwise might in the face of what we think is going to be decelerating economic growth moving forward.
I do appreciate you breaking all that down for us. Richard Duchazal, William Blair, macro analyst, thank you for your time this morning.
Thanks for having me.
Well, the world's major central banks have raised rates at the most aggressive pace in 4 decades and are now at a critical point in their fight against inflation. Surprise hikes from Australia and Canada spooked investors and raised concerns over more tightening ahead. Over the next 2 weeks, the Federal Reserve, European Central Bank and Bank of England must decide how much further they can push. Yahoo Finance's Jennifer Schomburger has the story for us. Jennifer, what are you watching?
Good morning. That's right, Rochelle. Well, the Federal Reserve here in the United States expected to pause rates for the first time this week. Other central banks around the world are forging ahead with more rate hikes to tame stubborn inflation. After 8 consecutive rate hikes, the European Central Bank is expected to raise rates again by 25 basis points on Thursday, even as the Eurozone has slipped into recession. ECB President Christine Lagarde said last week it was too early to call a peak in core inflation and reaffirmed rates would need to be increased again. Economists also expect another rate hike in July before the ECB pauses for the rest of the year. The Bank of England is expected to raise rates at its next meeting on June 22nd by 25 basis points to at least 4.75%. Investors expect rates in the UK will hit close to 5.5% before the end of this year, marking another full percentage point higher after 12 rate hikes since December 2021. Last week, Canada surprised and raised rates for the first time since January after that bank paused its aggressive rate hike campaign to take a step back and assess whether it had done enough to bring down inflation. Australia also raised rates last week and warned of further rate hikes going forward. Back here in the United States, after 10 consecutive rate hikes, the Fed expected to take a breather itself to take a step back and assess whether it's done enough to bring inflation down. Rochelle?
And Jennifer, it's interesting because we tend to sometimes look at Reserve Bank of Australia as sort of the harbinger of what might be next. Do we get a sense of perhaps when we might see some of these global central banks on the same page?
Yeah, global inflation still remains an issue. The fact that you are seeing the Eurozone in recession right now indicates that perhaps there has been some traction being gained there. However, they are expecting a few more rate hikes or one more rate hike before hitting that pause button again. So I think it's this very much like take a step forward, wait and see, then take a step back. I think as we get towards the back end of this year into the fall, we'll have a better sense of whether demand has slowed down enough to bring down inflation and bring all of these central banks on the same page.
Indeed, it does seem like from month to month, they seem like they have an idea of what's happening, and then you get like some surprise consumer data and it could throw everything off. A big thank you there to our very own Jennifer Schonberg.
Consumer spending here in the U.S. versus consumer spending in Europe, you are seeing the consumer much stronger in the U.S. versus in Europe, where they have cut back a lot more. So there are different dynamics in play depending on what country you're in.
True, definitely worth keeping in mind. Thank you so much, Jennifer. All right, coming up, former President Trump under the spotlight today. We'll tell you the latest next.
Federal prosecutors unsealing an indictment outlining 37 charges against former President Donald Trump for mishandling classified documents after leaving office and then blocking the government's attempts to try to recover those documents.
I'm more interested in the political ramifications of this. And it seems to me that any Republican who veers into thinking that this is a serious issue that compromises national security is not going to fare very well among other Republicans. And I think that's one of the more interesting aspects of this case. The politics of it are going to be just stupendous to watch.
Somewhat amazingly, this does not really hurt Trump among Republican voters. He retains a sizable lead in the polls, and in some ways, this seems to benefit him among his supporters. He may end up convicted of crimes by the time the election is actually held in November of 2024. How do we spin this forward for the market? This is probably a reasonably good outlook for markets. If it's Biden, markets are good. And if it's another Republican, Republicans generally are friendly toward markets and toward businesses. So I think that's pretty good too.
If the stock market is right, we've really still got a stock market rallying by the end of next year, and inflation has come down immediately to 2% by that point, and there isn't terrible unemployment. Whether he's indicted or not isn't going to make much difference.
Former President Donald Trump is set for his second court appearance as a criminal defendant in Miami today, facing a 37-count indictment for mishandling classified documents after leaving the White House. Now, a poll from ABC News and Ipsos has 48% of respondents saying the DOJ was correct to charge him, while 35% disagreed. And another poll from CBS News and YouGov showed an overwhelming 80% of GOP voters think that Trump should still be eligible for presidency, even if convicted. Steve Schmidt, political strategist and founder of the Warning newsletter, joins me now. So just break this down for us, because whether indicted, convicted, incarcerated, constitutionally, is there anything that could stop him from becoming president?
No.
Fair enough. So then why do you think there's so much discussion about the sort of will they, won't they? And what's the likelihood that he actually does end up being incarcerated based on the indictment that you've seen?
Well, if you were to look at the indictment, judge it by its seriousness, the detail, and look at comparable situations and sentences, including with people who are far more sympathetic than Donald Trump, the chances of him being sentenced to prison would be exceedingly high. Of course, in the American system, everybody is presumed innocent until found guilty beyond a reasonable doubt. But there's no question that what the prosecution has laid out on the 37 charges is an egregious level of misconduct, an egregious level of misjudgment and recklessness. And this is the type of information that people get killed over, that people die for. These are the most sensitive secrets of the United States. If you think about a young woman, a young man who is flying a mission off an aircraft carrier in an Air Force jet into hostile airspace, this possession risks their lives. These are very, very serious matters, and they speak really, I think, also to a societal and political degeneracy inside the Republican Party, that people who know how serious this is, nevertheless, remain completely intimidated, scared to death of Donald Trump being criticized by him, and will not therefore acknowledge the seriousness of the matter, to their great detriment.
So then let's talk about some of these political ramifications. I mean, we've already seen sort of the president lashing out at people who've been supporting DeSantis after perhaps he had helped them get into their positions. What does this mean then if you sort of have to pick sides and you have such a crowded list of GOP candidates who have put their names forward for president?
I don't know that there's any sides other than Chris Christie seems to be standing alone, singularly being honest in this moment about the seriousness of what all of this is. Every other candidate, most of them have long records of sycophancy towards Donald Trump, served in the Trump administration. They just will not criticize him, which means all of these people who could not stop talking about Secretary Clinton and her emails in 2015, all of them who have filled up volumes with quotes about the importance of protecting classified information, every one of them is contorting themselves into positions trying to defend the indefensible. I think a great example of that is Lindsey Graham stammering through his appearance and
All right, we appear to have been having some technical issues. We couldn't quite hear you there, but a big thank you to Steve Schmidt, political strategist and founder of the Warning newsletter. Thanks so much. All right, coming up, we have more market coverage coming up, and a settlement has been reached between JP Morgan and the victims of Jeffrey Epstein. We've got more on that coming up next. JP Morgan says it's reached a tentative settlement in a lawsuit brought against the bank by an alleged victim of the bank's former client, deceased sex offender Jeffrey Epstein. The case is one of 2 civil cases that the bank has been defending over its relationship with the late financier. Yahoo Finance's Alexis Keenan joins us now with the details. Hey, Alexis.
Hi, Rochelle. I didn't hear all of what you said there, but I think I can pick it up from here. So we have a lot of news coming in one of the 2 cases that was brought against JP Morgan Chase, and that is that the bank has reached with these alleged sex trafficking victims of the late Jeffrey Epstein a tentative settlement, and we're told by the plaintiff's lawyer, David Boies, that that settlement number is $290 million. Now, remember those victims, they were alleging, hundreds of them, according to this complaint that was filed as a purported class action suit, that there were hundreds of minor victims at the time who said that they were harmed by the bank's relationship with Epstein because it provided banking services that they say fueled his international sex trafficking operation. Now, this case being one of these 2 suits that JP Morgan was facing over this client relationship. The other was brought by the government of the U.S. Virgin Islands. Now, though this settlement, it really does raise some additional questions, including the number of victims that this tentative settlement covers. In a statement to Yahoo Finance, the plaintiff's attorney, David Boies, said this: the bank has asked us not to reveal the number of victims at this time, and pending further discussions, we are going to respect that request. Boies also said that taken together or individually, the historic recoveries, he calls them, from the banks who provided financial services to Epstein speak for themselves. Now, what he's talking about there are a settlement reached last month by Deutsche Bank. That settlement with JP Morgan, $75 million. So this $290 million being quite a bit more than that there. Now, this settlement does still have to be approved by the judge, as does the one that is proposed with Deutsche Bank. Also, this settlement comes after JP Morgan CEO Jamie Dimon was deposed about 2 weeks ago, saying that he had no knowledge of these alleged nefarious activities, criminal activities alleged against Epstein. And also after the plaintiff's lawyers here have asked in a letter on Friday to the judge that was presiding over this case to re-depose Jamie Dimon, saying that the bank was strategically withholding documents they say were critical for them to be able to go ahead and examine their various witnesses in the case. Now, also in a statement from JP Morgan to Yahoo Finance, the bank is saying this: we all now understand that Epstein's behavior was monstrous, and we believe this settlement is in the best interest of all parties. The bank going on there to say any association with Epstein was a mistake, and we regret it. We would never have continued to do business with him if we believed he was using our bank in any way to help commit heinous crimes. Now, this does not end the other lawsuit that the U.S. Virgin Islands government has brought against the bank. That case, though, also JP Morgan has filed a third-party complaint alleging that its executive who is handling the relationship with Epstein, his name is Jess Staley, that he is the one to blame here. So a lot to watch here, Rochelle, and we certainly will bring you additional updates as we find them.
I appreciate you getting us up to speed there. Big thank you there, Alexis Keenan, there for us. Well, hedge funds are doubling down on their bearish bets in the Treasury market, betting that rates will stay higher for longer ahead of Wednesday's big Fed decision. Let's go now to our very own Jared Blickery to learn more about it. Hey, Jared.
Yes, let's take a look at this beautifully purplish chart here. This goes back about 5 years, and this has 2 different time series on it. Time series being the lines that we see. The cyan, the light blue line here, that is the 2-year Treasury rate. It closely monitors or tracks what people think the Fed is going to do with interest rates over the short to medium term. And then the filled in portion, that dark part, that is hedge fund positioning vis-a-vis these weekly reports we get from the Commodity Futures Trading Commission into your notes. So the first thing I want to point out that if hedge funds are bears shorting treasuries, they're betting that yields are going to go up. That is because the price of bonds, as they go down, they are inverse to yields, so yields must go up for that to happen. And you can see right here, starting in about early 2021, we saw a huge liftoff in 2-year rates. And we remember that's back when the Fed was first starting to get hawkish and really concerned about the inflation that we finally was revealed to be not transitory. All of this meaning that hedge funds are actually pretty rosy on the economy. They think that going into the end of the year, we're not going to have rate cuts. Well, why would we have rate cuts going into the end of the year? That would be the result of a hard landing or maybe even a softish landing, and that would spell recession, but hedge funds are not seeing that right now. A couple of caveats. Just because hedge funds are betting on this way doesn't mean that it has to come true. They're not always right, but it's important to study when positions get crowded, because if they are so heavily betting on one side of this, well, what can happen is if there's a change in tone, if there's a change in sentiment, that can lead to a very painful unwinding. And as we've seen, bond market volatility leaks into the stock market, and that's where most people are really concerned about getting in and out of positions. Let me just show you as a measure of bond market volatility. Here's the B of A move index. So this is kind of like the VIX of bonds I like to go to. Now it has come up, it has come down actually quite sharply off the highs. So along with the VIX, it's showing lower risk than we saw previously in the year, but you're going to notice it's still pretty elevated. 2022, these are elevated readings, and we're only back down into the area of the lows there that we had around those 2022 lows, not even the lows themselves. So there's a lot more that could happen in the bond market. You compare that to the VIX, this is stock market volatility. Well, we're at the bottom end of this range. In fact, we're at the lowest level in years. So the bond market and the stock market are saying something differently. All of this to say, with all these huge, huge bets on the market, tomorrow's CPI reading, Wednesday's big Fed decision, those are just going to be bigger, guys. So really got to pay attention to those, and we'll see how the bond market reacts to all of this.
Indeed, a lot riding on that, and I'm sure that we'll be passing through every single word that comes out of Powell's mouth after that announcement. A big thank you there, our very own Jared Blickery. Well, today marks the deadline that Binance and Binance US had to respond to the SEC's application for a temporary restraining order, while tomorrow we will see the motion for a hearing. But taking a look here, in the 6 months following the FTX bankruptcy in November of 2022, there has been an increase by an estimated 183% on crypto-related enforcement from the SEC. As we dig deeper into that, it's unclear how these lawsuits will change the crypto industry and how it's regulated. But observers are also noting that these tougher regulations may simply be an attempt by the SEC to redeem itself for failing to regulate FTX. All right, coming up, mobility tech company IXIC is the first Chinese automobile smart tech startup to be listed on the US stock market. We're breaking down their latest earnings next.
Curious about what's going on in the housing market and whether or not it's a good time to buy this home or another one? We've got you covered. We've got a jam-packed week filled with experts, including real estate agents from across the country. We'll also get a temperature check on the state of home building and whether or not it's a good time to stack up on those home builder stocks. We've heard from home builders that they're capitalizing on the housing shortage. We'll also tap into commercial real estate. Is it doom and gloom after all? And can't forget, we'll hear from the real estate queen herself, Barbara Corcoran. Tune into Yahoo Finance Live all week long.
Mobility tech company IXIC is vying for its place in the growing automotive computing market. The business went public via SPAC last year with a valuation of $3.8 billion. It's backed by Chinese auto giant Geely and produces in-car productivity and infotainment products. Its technology can be found in around 5 million vehicles globally. Today, it reaffirmed full-year guidance, citing strong demand. Joining us now is Ramesh Narasimhan, IXIC's CFO. Thank you for joining me this morning. So, walk us through some of this earnings report. I mean, GAAP EPS beat by about 6 cents, revenue missed by $0.48 million. What are your big takeaways from this earnings season?
Yeah, good morning, Rochelle, and thank you for having me here. It's been a very, very strong performance in Q1. Revenue grew year over year at 16% in an environment where the production, specifically in China, year over year has been down 10%. Our profitability is very strong. Our gross margin grew 52%. Adjusted EBITDA was very, very strong. So we're pretty excited about the prospects and what we are seeing. There's a very strong demand as we are helping with the industry to transition to more electric vehicle future. And certainly we are pretty excited about the growth opportunities that we're seeing. And yes, we reiterated our profit and our revenue guidance for this year that we will get to 700 to 720 million, which represents about a 38% growth versus last year. So very exciting milestones for us to achieve.
And what's driving those projections? Because, a lot of people are wondering, should I be tightening my purse strings in a tough economic environment? What is giving you some optimism there in terms of this full-year guidance?
Well, I think the shift towards electric vehicle is happening quite rapidly. We're certainly leading in the leading market from an electric vehicle perspective. We're seeing very, very strong demand for our products. Certainly the importance of customer experience inside the vehicle is gaining a lot of importance, for which you need very strong technology providers. And we are pure play automotive, and that's a key differentiation with a lot of other players. We're pure play automotive. We are vertically integrated. What that means is we have end-to-end solution at a very, very cost competitive pricing, but also simpler and quicker to implement. So all of that gives us a lot of confidence with the growth that we have forecasted.
And some people might not be familiar with the company, but they're familiar with a lot of the brands who use your products and services, including Mercedes-Benz, Volvo, Lotus, Smart, and Polestar. Talk about the play there, because it's hardware and software as well, and what you really bring to the car experience. Because I think of you guys as sort of the Internet of Things of cars.
Yeah, well, I mean, very simply, we're a mobility tech provider. But it's a lot more than that. We are, as I said, we are vertically integrated. We do software on chip. We do the operating systems. We do the software stack on top of it. So anything that enhances the digital customer experience inside the vehicle, we enable it. So what is really critical is the speed, the performance of the tech behind the scene, and that's what we are involved in.
And I want to ask you about the future of dashboard tech. I know a lot of us are already a little bit distracted, but we are seeing a lot more development there. And you have a collaboration with Epic Games' Unreal Engine. Talk about what you're hoping to bring to the dashboard experience.
Yeah, I mean, certainly, as I said, the digital customer experience inside the vehicle is getting enhanced quite a lot. Earlier this year, we partnered with AMD and with Unreal Engine to showcase 3D graphics and gaming capability inside a vehicle. Of course, very important to note that the driver cannot use it while they're driving, but the requirements from a customer perspective is certainly increasing. And what this does, our partnership has enabled us to do is to have a real gaming experience like you would have at home inside the vehicle. So it is starting to get seamless integration into your vehicle and mobility.
And a lot of people are looking at what's next in terms of autonomous driving. I know Elon Musk told CNBC, he said we may see fully autonomous vehicles by the end of this year. Do you have a sort of timeline for that?
Yeah, I think autonomous vehicle is something beyond the scope that we are working on. We are a key enabler in terms of, as I said, the digital customer experience. But it is important to see that the industry is certainly focused on enhancing user experience, whether it is autonomous driving or whether it is the gaming I just mentioned. So I think there is a lot of engineering focus on enhancing the driving and the customer experience. So I think it will continue to evolve.
And I know you mentioned AMG. I did want to ask you about any concerns that you have about the chip race here, and especially when there's this sort of clamoring because of AI and everything else for certain kinds of chips. Are you seeing that affecting sort of the way you're able to do your work, or perhaps the sort of development for products and services that you have?
No, we have a number of partnerships that we work with. We have got our own SoC where we have developed a 7-nanometer chip with one of our JVs called SiEngine. We partner with AMD. We use other products as well. So we are very, very comfortable to have a partnership ecosystem. Our main objective is to deliver the best product, what the customer is looking for, and to enable that digital customer experience. So we don't see an issue in terms of these partnerships that we have. It actually enhances the capability and the products that we can offer.
I do appreciate you joining me this morning. Ramesh Narasimhan, ECARX's CFO. Thank you for your time today.
Thank you.
Well, the indictment against Donald Trump marks the first time a former president has faced federal charges, but there's no clear path ahead for what this means for his presidential campaign. Trump is currently the leading contender for the GOP nomination. On Friday, Yahoo Finance hosts Akiko Fujita and Shauna Smith spoke with James Carville, political strategist and host of Politics War Room, about what the indictment means for Trump's 2024 aspirations and the future of the GOP.
If you do what I do and spend your time listening to Fox and right-wing radio, you would think this was the equivalent of a failure to yield a right-of-way violation. I'm more interested in the political ramifications of this. And it seems to me that any Republican who veers into thinking that this is a serious issue that compromises national security is not going to fare very well among other Republicans. And I think that's one of the more interesting aspects of this case. The politics of it are going to be just stupendous to watch.
Yeah, James, talking about those political potential ramifications there, ahead of these charges, Donald Trump was viewed as the leading contender for the GOP nomination for 2024. Does this change that at all?
Yeah, I wish I knew what the Dow was going to do a month from now. It looks like the initial reaction is to rally around the flag, clearly among Republican commentators, among right-wing elites. There are some people that are even suggesting that other people shouldn't run against Trump for the Republican nomination. That seems to me to be quite extreme. I don't think Chris Christie is going to listen to that, but there's going to be a backlash, and they're going to have to answer the question everywhere they go: will you pardon Trump? That's going to be that is the number one question that Republican presidential candidates are going to have to answer from now going forward. And I really don't see this. I don't know if it's going to change. If some Republican voters will be upset about it. 37 counts, according to people who know something about this, these are pretty specific and pretty substantial allegations that are being made. But I'll leave that judgment to others. But for the politics of it, it's going to be a fascinating ride.
Well, and we've already had a number of GOP presidential candidates who've essentially sort of suggested that he will be pardoned if, in fact, he is found guilty on these charges. I mean, does that tell you the hold he still has on the party? And does that essentially answer that question you just asked, which is, will this even make a dent in his support within the party?
Well, it's certainly not going to make a dent with his hardcore support, if that's 45% of the party. But the Republicans can't win without the hardcore Trump people. And they will demand, and I suspect they will get pledges from all of the major Republicans that they'll pardon Trump. Now, as these facts come out, they're going to be very difficult. But if you listen to right-wing radio and Fox News, which I do, and by the way, most of my friends who are substantial in this business are listening to Fox and right-wing radio, you hear more talk about the Biden crime family and Hillary's emails than you do about, showing people national security secrets. So it's going to be fascinating going forward here, I promise you. And and these things can develop. I would say I think one of the most important events coming up is the trial that Trump is facing. We're forgetting about this in Manhattan in March of 2024. That's that's being sort of sloughed off and lost in the shuffle here. But if there's a guilty verdict there, that could change equations. By the same token, if he's found not guilty in a Manhattan jury, that would change equations the other way. But I think that event is kind of being underplayed in the national media in terms of its certainly political significance and maybe even legal significance.
James, when it comes to the political significance of this, what about the fallout beyond the presidential race when it comes to the GOP in the House and in the Senate, with all the focus here, much of the focus on these cases that Trump is facing and not on the Democratic rival, the runner that he or one of his GOP runners will end up going up against?
Well, that's a very relevant and a very smart question, because if you're running for the county commission, I'm here in solid red Shenandoah County, Virginia, you're going to be asked about this. This is going to be a litmus test. But if you're running for the Senate, or if you're running for the House, it's really going to be front and center. But I don't think there's a Republican candidate in a primary or even a general election that's going to be able to escape this question.
James Composite interviewed by Akiko Fujita and Shauna Smith there. All right, coming up, the state of play. Dan Howley chats all things gaming with Xbox leadership after this weekend's games showcase. You won't want to miss it. Xbox Games Showcase unveiled dozens of new games for the platform over the weekend. Xbox's gaming growth has surged in the past year. The company saw a 46% increase in PC Game Pass players last quarter and reached a record 150 million active monthly users on first-party games. Well, Yahoo Finance's own Dan Howley is here with Sarah Bond, Microsoft's Corporate Vice President of Game Creator Experiences and Ecosystem at Xbox. Dan, take it away.
Thank you so much, Michelle. How you doing there, Sarah? I just kind of want to jump into things right away. You guys had a huge show, massive number of announcements out of Xbox, especially for first-party games. I guess, was this Xbox way of kind of conveying to gamers who may have been clamoring about fears that Microsoft or Xbox wasn't pushing out first-party games, that the company is indeed dedicated to this and there are more coming?
Xbox has always been dedicated to this. We've been working for years and years and years on the games that we revealed today. So it was pretty fantastic, frankly, to get the opportunity to show to fans all of the dedication and work and the things that we've been creating for them. All told, we had 27 games in the show, and 13 of them were for our first-party studios, 21 of them launching into Game Pass.
And I watched this with my friend. One of the biggest events from the show was kind of the big Starfield event afterwards, as well as the gameplay trailer during it. This is the first new IP from Bethesda in more than 25 years. It's also one of the most anticipated titles for 2023, as well as the biggest one from Microsoft and Xbox Bethesda since Microsoft acquired it in 2021 for $7.5 billion. I guess, how much is riding on this game?
You know, every game that we make is important and special. And it's been really fantastic to get to partner so closely with Todd and the team at Bethesda as part of Starfield. I truly believe that this team has created something that defines this generation of gaming. You know, getting the chance to talk to Todd about the vastness of the world, the detail in the gameplay, the number of different choices and creative choices you can make, and getting a chance to experience a little bit of myself. I cannot wait for you to get your hands on it, and I sure hope that you enjoyed it yourself watching the Starfield Direct and the showcase.
Yeah, I'm going to have to call out of work mysteriously when that lands in September. One of the things that Microsoft had announced was, Xbox now has 150 million monthly active users in first-party titles. As far as Game Pass goes, are you seeing the uptick as a result of that and the games landing on Game Pass? Because, while I was watching, it seemed everything that was announced is just going to be on Game Pass the day that it launches.
Yeah, Game Pass is one of the things that players love about Xbox. And all of our first-party titles do launch into Game Pass. And our subscription business is actually now sitting at over $1 billion a quarter. And so we have just experienced tremendous growth there. That said, another reason why our first-party titles are so popular is we are committed to making them playable, as in many places as people want to play. We also have a very vibrant PC business. We actually also crossed over $1 billion on PC as well.
I guess just, as a final here, the 800-pound gorilla in the room, speaking of Game Pass, speaking of, the cloud opportunity that Microsoft has is the Microsoft Activision Blizzard deal. And I know Phil Spencer had mentioned that during the conversation yesterday. Where does Microsoft stand on that? And what can we expect?
Activision Blizzard King, that deal has always been an accelerant to our strategy. And we just continue to work with regulators around the world in open and constructive dialogue. If there's lingering concerns, we want to address them. If there's problems, we are absolutely committed to finding solutions. But we're sitting at a point where almost 40 countries in the world that cover over 2 billion gamers have approved. And I really look forward to seeing through the process and being able to bring amazing value to players and creators in conjunction with the team there at Activision.
All right, Sarah, thank you so much. It was a blast to watch, by the way, huge, gamer. So just excited to get my hands on some of those titles, especially, by the way, just the Persona and the Like a Dragon games. My wife and I play those all the time. Rochelle, back to you.
All right, a big thank you there to Dan Howley and Sarah Bond, Microsoft's Corporate Vice President of Game Creator Experiences and Ecosystems at Xbox. Well, let's get your final check of the markets as we head into the noon hour. Still looking at positive territory, still in that narrow trading range. The Dow, they're up about 0.1%. The S&P 500 up about 0.33%. Tech heavy Nasdaq, they're seeing the strongest gains so far, up 0.7% or about 98 points. That does it for now. I'm Rochelle Acufo, but I'll be back with you at 11 a.m. Eastern tomorrow. See you then.